Here.
Okay, good morning, everyone, and welcome to the investment meeting. I apologize for the delay, but of course, with this no webcasting, there are some issues that arise, and it's the first day that we're doing it, so just bear with us. With that, Rosemary.
Good morning, everyone. Rosemary Develis, representing Police Commissioner Raymond W. Kelly.
Barry Dennis, SAS. Joseph Alejandro, PBA. Chris McGrath, PBA.
Bob Ganley, SBA.
Dennis Gannon, LBA.
Roy Richter, CEA. Michael Palladino, DEA.
Valerie Buzzard.
Ricardo Morales, Controller's Office.
Barry Miller, Controller's Office.
Dave Dieter, Controller's Office.
Martin Gas, Controller.
Thad McTee, Controller's Office.
Seema Hingorani, Controller's Office.
Larry Schloss, Controller's Office.
Ranji Nagaswamy, Mayor's Trustee.
Janice Emery, Office of Finance.
Rob Goldrich, Mayor's Office.
Karen Seaman, Law Department.
Kevin Holleran, Police Pension Fund.
Larry Smith, Law Department.
Bob Sensky, State Pension Fund.
Steve Mazarek, SIS.
Yvonne Nelson, Controller's Office. Ranji Nagaswamy, Pension Fund.
Okay, welcome to the public session. Larry.
Okay, we're going to start with our monthly performance review. I'm going to skip through the economic slides pretty quickly because we have Deutsche Bank coming in for our quarterly view of the economy. Does everybody have one of these, or do you need a? No. You got it? All right.
Anybody else?
Okay. So if you go to page 2, you see that this is the GDP slide. The economy's bounced back up. People are talking about 2-3% growth again. I won't steal Deutsche Bank's thunder. It's what the future looks like. If you go to page 3, you can see capacity utilization is ramping up nicely. It's in the mid-70s now, was in the low 80s. Same thing on the next page for the ISM manufacturing index, again, turning up nicely. The economy's turning. You can see it reflected on page 5 with the unemployment claims trending downward, which aggregates on the next page, page 6. Unemployment down to about 8.8%, still unacceptably high, and I'm sure Deutsche Bank will comment on that. The consumer on the next page is sort of resiliently flat, but feeling a little better. The reason it's going down the way it does in the last month was the impact of the tsunami in Japan, but I presume that'll come back in the next month or two. Page 8 is architectural billings. Hang of all of the mortgages, and you can see it dramatically on page 10. New home construction continues to be just in the cellar, and that's a problem for construction jobs and helps the unemployment rate stay high. Retail sales in 11, doing all right, growing about 2-4%. Auto sales coming up nicely, page 11, although I'm sure there'll be some glitches with supply chain issues from Japan. Page 13, you can see index of leading indicators are looking very good. Again, nice trend upward from the bottom. CPI, I'm sure again Deutsche Bank will talk more about it. Inflation's coming back a little bit. Price of oil is up, as well known. Raw materials are up, food is up. The Fed seems not to be very worried about it. In fact, the Fed likes inflation around 2-3%. It's below that, so they're not too upset about it yet. Moving straight into page 16. The euro is going up relative to the dollar. That's a combination of the euro interest rates just were raised today or yesterday, and the dollar being the QE2 and the Fed pumping a lot of cash into the economy. You can see again more dramatically on page 17 the decline of the dollar in the last few months. LIBOR on the next page, page 18, pretty flat. Things are okay on one level in Europe amongst the banks lending to themselves, which is what this rate is. The next page, 19, you can see the definite spike in mid-March. Again, that's 100% caused by the tsunami in Japan. Back to more normal levels right about now. Having said that, the Controller's Office is very anxious about things that are going on in Europe, as well as the governmental changes in North Africa and the Middle East. So we'll get back to what we've done to try to protect the pension funds, but it's not reflected in the VIX. I would tell you risk is getting more and more underpriced in the markets, but again, it's not in the VIX. I'll come back to that again in a second. Page 20, the white line is the current yield curve. Rates went down. That's actually more dramatic on the next page. Page 21. Again, this dip that you see at the end in March is the tsunami. Everybody rushing to the dollar again, rushing to the dollar. You buy treasuries, so the rate went down as far as 320. It's back up to 360. We expect it to continue to go up in the future, although not that dramatically, but up. Similarly, in search of return, because the Fed's got rates down, you can see spreads narrowing, high yield spreads as well as investment grade spreads. Recall that we lightened up our high yield bonds in the last several months. Excuse me, page 23, you can see how the main global industries are trading on a forward PE basis. Bottom line here is they don't look very expensive, which is why the markets are going up. And you can see similarly the U.S. indices on page 24, large, medium, and small cap, a little more pricey, but again, not very pricey if you believe the economy is going to continue to rise over the next several years. That gets you to page 25. The stock market, again, you see late March, everybody dipped, it's down about 5%, and now they're all back to basically the pre-Japan tsunami levels. Page 26 shows you a pickup in M&A activity. M&A activity is basically means that CEOs feel better. CEOs feel better, they go acquire other companies, they've got a lot of cash on their balance sheet. That's a good sign. It's sort of a leading indicator of confidence in the economy and confidence in the business. Page 27 is the police pension fund assets. We're at $24 billion now, all-time high, which is terrific. Congratulations. In fact, it's 6% ahead from the peak before the 2008 decline. So everything's worked out well as far as the police pension fund's concerned. If you look on page 28, you can see that basically in the last year it's pretty much been nothing but up, which is terrific. Page 29 is the asset mix. The asset allocation, you can see that at the end of February, we were over allocated out of the band for U.S. equities. In March, we sold about 2% of the equities, so we're basically back at the top end of the range. We have it in cash, temporarily in cash. We might just keep it in cash again because we're a little worried about too much risk not being priced into markets. It's getting to be, I wouldn't say priced to perfection yet, but there's frothiness in a variety of markets, and we're anxious. So, as I'll show you, if we jump to page 31, the third column is what we want to protect. The third column is fiscal year to date, we're up 20.7%, which is just spectacular. So there's really no need to push risk. What we want to do is protect our gains. The month, if you look at the far left corner of the month of February, we're about 2.4%. March, just to give you a glimpse of the future, March was pretty much, it was bouncy, but as of sort of yesterday, we're back up to the same levels we were before. So we're back up to, again, $24 billion. So the returns are still good. We're, again, through March, we're 9 months through the fiscal year, so we feel very good about it. And if you look at the far right bar, the 3-year return, which again includes the 2008 decline, we're up to 3.2%. So good riddance to bad markets. Page 32, you can see why February was so strong. In the far left column, all of the indices were up, a little bit down in emerging markets. Basically, everything was up, which continued the trend from January. If you look on page 33, You can see the mix of the assets. And Seema has a couple of comments on some of the equity markets.
I'm sorry, just before we go on. I noticed the actuary's not here today, so you could have opined on some of the return and how long it will take to make up total losses that we had in 08.
We made them up.
We made them completely up, or it's gonna be a few
Completely up.
more?
It won't be in the
Little while
number,
longer.
it won't be in the numbers for 7 more years,
Right.
the way it gets amortized.
Well, you're right, the
Right.
amortization.
But we totally made them up.
Good. I'm sorry.
Before we jump in, I completely agree with the very high level of risk concentration we have in equities. We've all talked about that a lot. I do think, though, we should think about more than just a move into cash, some ways to think more proactively, Larry, about hedging that risk. 2% won't make a dent if the market goes down 10-15%. So I just wonder if, Barry, you have some thoughts on, I mean, essentially, we're talking about tail risk hedging. It's a complicated topic, but it's just, since I've been here, this is the first time we've made it. Well, actually, it's not a first active move at all, but it's the first move into cash.
Yes.
Which is a safe place to be. It's not like returns are going to be very high in any place. But my question is there a way we should be thinking about this? And I understand it takes an RFP, it takes some doing, but is that worth doing in a portfolio like ours, given the concerns that I expressed?
I prefer to get a more balance in our portfolio, but because of the basket rules, that's difficult to do in the short term. My opinion on buying puts on the market is that they're still very expensive. And if you're looking for short-term protection, they're even more expensive than, say, a 1-year sort of put. So I would caution against that. So the cash has its problems, there's no doubt about that. And there may be some better alternatives to cash in maybe 2 to 3 year point on the curve. But other than, while it's moved to cash, we're still at the upper end of the bound.
Exactly
So,
right.
It's, I don't see that as being too defensive, moving to cash. Something we have to keep an eye on, and it should behoove us to move as fast as we can on getting legislative relief to diversify the portfolio. That would be my primary approach.
But we're not authorized to buy puts, right?
Right.
We don't have the authority to do that.
That's right.
Okay.
But I think what you could do is you have managers who do overlay strategies, right? So we wouldn't take the risk on, but we could put on an overlay strategy with the manager. So that there's nothing to stop us from doing that.
I don't have an answer to that. I'm not sure.
Well, I don't think, A, we can't do it the way we're set up. We have to have an RFP for that kind of manager. B, we're going through the asset allocation now, right? I think Barry's got the long-term solution, which is diversified, right? Short term, every time we've talked about it, we've bounced it off of a few people. It's very expensive to buy the tail hedge in this size. That's not to say we shouldn't keep looking at it, we should keep talking about it, but the actual execution of it would take us an RFP, so it'd be months away. Although we are gonna shorten the RFP process, which is something we're gonna talk about later, but,
Well, I think
point taken on, it'd be nice if we could figure out a way to hedge against sellers. And, we're looking into it, but, it's not something we're gonna do in the next 30 days.
No. But I think it behooves us. Right now, you've done 2%. If we come back to a time when you want to do a whole lot more, we've just got to start getting educated about how can we create it so that you can do this very quickly. And I think if you had an RFP where you brought a manager in with a very open mandate and say this is a hedging portfolio, we'd have to talk about this at a different time. But
Just one
just
question.
to close
How would that be allocated? Where in our portfolio would you allocate?
I think it would be its own line item, right?
I mean,
It would be
So
a hedge.
you'd
Or-
have to have, if I remember correctly, we'd have to look at the asset allocation. We'd have to vote to allow an allocation to that. Then we go into the RFP process to look for managers. Very time consuming. And
Well-
of course, keeping in mind with all the legal, regulatory constraints we
I see
have.
where you're going. I think the answer would be opportunistic. Because to me, opportunistic doesn't only mean going long, opportunistic also means hedging.
But that also would reduce the possibility, it reduces the debt that would actually take care of, right? You wouldn't be able to put maybe as much money as you could or need into that strategy to kind of counter the effects you want to.
I think we should think through the implementation. You're making good points,
Right.
no question. But the question is, as a board, I would like to start thinking about this and urge Banner
There are a
to
lot of
give us
things
a
we need to be
proposal.
thinking about, but.
I'll add that we're close to publishing a research paper on what's called global tactical asset allocation, which is done in an overlay. It wouldn't require a commitment of capital from the fund, a small commitment to service margin for derivative instruments. That may be a solution. And along with the discussion later on the agenda on opportunistic fixed income, the idea is to get more flexibility into the asset allocation process, because it's hard to react given the procurement situation. And even if we had a smoother procurement process, we have monthly meetings, and things happen within months. I think there's another solution that probably could be done before the broad diversification gets in.
Are we picking up any of this in the hedge fund allocation?
Yes, around
We
the edge,
would.
around
We
the
are,
edge.
we are
So if you
picking
think-
it up a little bit
Yeah.
on that, because that's part of their strategy.
Part of the reason.
Diversify
Yes.
that risk.
Yeah.
That's right.
I mean, so if you think about it in its pieces, you take the asset allocation discussion that we sort of started, you're adding hedge funds, which is a cushion. We're gonna talk about opportunistic fixed income, which is more active management of a portion of it, which is a cushion. All that stuff you're sort of taking out of equities. You're gonna add perhaps another couple of asset classes, maybe commodities. And you're trying to diversify it so that you don't have the big risk. Having said that, when things go really bad, everything goes bad together, right? Hedge funds might be a little different. But I think what Ranji's talking about is something you just put over the entire thing. It says if the 1 in 1,000 event happens, everybody loses money and you're making some money. It's like an insurance policy. It's just
It's
this.
just like the cash stream.
Yeah, it's expensive, and it's a whole other discussion, which, you're right, we should continue the discussion about how we implement an insurance policy, for lack of a better way to put it. And it's very complicated, it's expensive, it's another line item. But we'll keep talking about it again. The beauty of doing the asset allocation conversation we've got going on is it gets everyone thinking about the whole fund as opposed to just a manager. We got someone coming today, a little later, GMO, they're gonna give you their views. As they said yesterday in another meeting, they're 50% cash now. So I'm afraid they are. 50% is a little extreme. We could never be 50% cash. But they're kind of hiding under their desks.
And that's a GTAA.
But I'll let them walk you through as to why they think that's the right thing to do for them. But again, more diversification, more asset classes. Should we have an insurance policy across the whole thing? If we do, what's the drag? Because it's a drag, we're paying someone to do that. But a much longer conversation. A good conversation.
Just ways to get more nimble with the variable.
Right. Way to get the tanker to be nimble. Okay? You want a couple
Okay.
equity comments?
Yes, I just have a few comments to make on equities. So, over the next couple pages, so pages 35 to 37, as we break out the Russell 3000, small cap, large cap, and mid cap, and our passive and active managers, I just wanted to remind you of the strategy that we put in place a couple months ago and we executed on, where we moved money out of the Russell 3000 to get more mid cap and small cap exposure. And as you can see, the trend that we identified over many years historically, where mid-cap and small-cap had outperformed large-cap, that trend continues, and we're benefiting from that now. So on page 35, you can see the differential, the Russell 3000 being up 3.64% in the month of February, the Russell 2000 being up 5.48% in the month of February, and then the S&P mid-cap, which is where we put some money, being up 4.65% in the month of February. Year to date, though, the numbers are even more dramatic. So the Russell 3000 through yesterday is up 6.5%. The S&P mid-cap is up 9.7%, and the Russell 2000 is up 8.4%. So that transition is working well for us. And then I would like to just point you to page 40, which goes through our exposure in emerging markets equities. And if you just scroll down to BlackRock, we're going to take BlackRock out because that is actually our new passive exposure to emerging markets, which we initiated a couple months ago, roughly $160 million for police. And year to date, again through yesterday, the MSCI Emerging Markets Index is up about 4.5%. And given at the time when we were purchasing this index for police, we're actually up more than that number because we got the benefit of the downturn a little bit and now more of the upturn in emerging markets. So far we've done well on that as well. And that's it for equities.
Okay. There's not much to talk about in fixed income. Martin's going to talk about opportunities for fixed income next. And similarly, since we've got some managers in real estate and private equity, there's not much to talk about there as well. I would turn your attention, however, in the agenda book to page 70. Page 70 is the Tux report comparison. In the far left-hand corner, the December results, the system was up 6.75%, puts you in the 17th percentile, so top quartile. And then if you look at the 6th column, for the year, we're up 13.96, also the 17th percentile. So for the year, you're in the top quartile of all large public pension funds, which is, I think, the first time you've been back in the top quartile since year ended December 03. So, great job all around. Congratulations, welcome to the top quartile again. Good place to be. So, unless anyone has any questions on the month is all good. We can bring in the Deutsche Bank guys, who we're going to go through the once a quarter update on what's going on in the economy.
Just before we go to the agenda, were we expecting some language on the disparagement issue? It wasn't on the public agenda, it wasn't on the executive.
Yeah, I think we actually were going to discuss that later.
Okay, so you're going to do that in executive session?
Yes, I think in an attorney-client.
An attorney-client, okay, I just want to know. Very well. Thank you.
You ready for first
Yes,
one?
we're ready for Deutsche Bank.
On the end.
David, take out this.
Whenever you're ready.
1 second.
Thank you.
Please. Good Good morning. My name is Lucille Douglas. I'm with DB Advisors, and I'm here representing both DB Advisors, which is the asset management firm within Deutsche Bank. With me today, I'm honored to introduce you to Torsten Slok. Torsten Slok is our Chief International Economist for Deutsche Bank, and with me as well is Aaron Doyle. Aaron works with me within DB Advisors. We're very delighted to be here. The reason we're here is to have Torsten present his views and perspectives on geopolitical risks, specifically the implications for U.S. recovery and financial markets. Specifically during the discussion, Torsten will speak about areas which may be of interest to you in terms of the Middle East crisis, Japan, and the Eurozone sovereign debt crisis. So with that, what I'd like to do is to introduce you to Torsten Slok, and also to think about this as a conversation. Welcome any questions that you might have.
Absolutely, thank you very much, and thank you for having us. I'll talk about geopolitical risks, specifically, as Lucille mentioned, the risks in the Middle East, and the risks coming from Japan, and the risks coming from the Euro area. And the important way to look at this is to ask the question, why are these risks and how are these risks important for the US recovery? And how are these risks important for financial markets? And what you see on page 1 is the outline. And one way that I think about geopolitical risks is in terms of what can we quantify and what are the transmission channels in terms of the implications not only for the recovery but also for financial markets. And one investment advice that has always been good when you have a hard time quantifying things is that you should buy when the news is the worst. The problem here is that we need to think about when are the news the worst, both in the Middle East and also in the Japanese situation and also in the Eurozone. So I'll walk through the channels through which we can quantify things and ask the question, what are the implications for the US outlook and for financial markets? In summary, on page 2, the first event of things that are happening in the Middle East, the main transmission channel is really oil prices. The reason why oil prices are so important is, of course, that it matters for consumers and it matters for companies. So that's why oil prices is the main way that we think about what the implications are of the geopolitical risks that we are seeing in the Middle East more broadly. For Japan, generally speaking, the risk is fairly small because the transmission channels here in terms of exports and imports are relatively small. We'll look at that in detail, but the main message on that is that as long as the nuclear situation does not deteriorate, then we think that this risk is generally less than the oil price risk. The final and third risk, the Eurozone crisis, and I'll talk a lot more about that in a minute, is very difficult to quantify because here we're dealing with a situation where several smaller European countries have gotten into fairly significant fiscal problems, and that's why the unpredictability of this event makes it difficult to quantify what it will mean, both for the recovery but most importantly for the banking sector. And we'll look at that also in a minute. So the way I would summarize this is that the Middle East is mainly through oil prices, which is a risk that's affecting the outlook and affecting the economy right now, whereas the other two risks are smaller, but in particular the Eurozone risks, if that does play out in a very unfavorable way, the impact on the outlook and also on financial markets could be very significant. So one way to look at the outlook on page 3 is to ask the question, what are the consensus expectations? What are market participants expecting will happen with the US economy on page 3? And what you see here is the consensus expectations to the performance of the US economy in 2011 and 2012. And as you can see, expectations in October were bottoming, and they have since then been moving up.
Yeah, do you have, it looks like the printing, there's some slides that don't have.
Sorry about that.
No, it's okay.
Okay.
I didn't think that.
I'm running ahead.
Sleight of hand trick.
Do you have the slides?
There's the bar chart here.
Before you pitch.
Do you have the?
What page is that?
It's
It's 3. Should be page 3.
Thank you.
Yeah.
Sorry about that. So
It's all right. Just one question. Is there one more event that you need to consider? I mean, a government shutdown in the U.S.? How would that affect also everything else?
we are obviously watching this very carefully.
So are we.
I can imagine. It's very difficult to quantify that risk, let me put it that way. But we're obviously keeping a very close watch on that because that could become incredibly important. The bottom line here is that the outlook and the expectations over the last 6 months have been improving, except here more recently, we have started to see a move down in expectations to how the US economy would perform in 2011 and also in 2012. So one, of course, could ask the question here, is this a sign of businesses and consumers starting to be a little bit more worried because of these geopolitical risks, or what is the source exactly of why expectations have started to flatten out in terms of the outlook for 2011 and 2012? So turning first to page 5, the Middle East risk, which is the chart on oil prices. One important issue, of course, is to ask the question, how much higher are oil prices than where they should be? And one way to do that is to look at, well, oil prices should be moving up with the economy. So when the economy is improving, oil prices should also be moving up. But at the moment, you have had oil prices actually move up more than what the improvement has been in the economy. And we quantify that the economy is currently at a spot where oil prices should be around $90. They are not $90. This is WTI. Instead, it's closer to $105, $107. So the premium is around around $15 in oil price. Premium, the risk of political problems in the Middle East, basically generating a premium and therefore elevating oil prices by about $15 above where they should be. And that's of course something that's important because oil prices obviously has a negative impact on the outlook. Specifically, one place on page 6 we are watching, especially when it comes to the impact of oil prices on the economy, is of course on the demand for cars. What you see in this chart here is total car sales in the US. If you look at from 1999 to 2007, car sales were running at a rate of 16 to 17 million. Then along came the financial crisis. Most importantly, the financial system got into serious trouble, and therefore car sales went down, and they troughed in the fourth quarter of 2008 at around 9 million. So an important reason why car sales fell so much was because there was simply no financing available. So in other words, if we had tried to go out and buy a car in the fourth quarter of 2008, the dealer would have said, do you have cash? And if we had said, no, we don't have cash, then he would say, well, then I cannot sell you a car because you cannot get financing. So that's why the financial system coming back has been a very important reason why car sales have been coming back. And that's what's very critical at the moment. Car sales are now coming back into the tunnel between the scrappage rate, the red line here. The scrappage rate is the rate at which we throw out cars in the US, which is around 12.5 million. And the per capita break even is the rate at which, if the population growth is taken into account, the rate at which to keep the car stock on the roads constant, you need to sell cars at a rate of around 15 million. So we are closer to that range now. But the reason why this series is so important is that if oil prices at these levels start to bite into car purchases, then we should start to see this as the first place of a negative impact on the economy, namely as car sales start to go down. That's why demand for autos, and specifically new autos, is a very critical indicator for watching whether oil prices actually are having a negative impact on the economy or not. And what's interesting to see here more recently is that so far up to this point, oil prices do not seem to have had a significant impact. In fact, we see car sales are still going up despite the increase in oil prices.
And where should it be? What about unemployment?
That's also very important, obviously, because for firms' decisions whether they want to invest in capex or not, it of course also shows up in oil prices being higher in capex decisions.
No, I was thinking about you need a job to buy a car.
That's certainly true also, and it's good that the unemployment rate has come down as much as it has, from peaking at 10.1 to currently 8.8%, but still 8.8% is above what the Fed would like it to be, and in that sense still way too high compared to where the unemployment rate should be. So it certainly is a problem, and it's a significant problem that we still have an unemployment rate which is fairly elevated. When we quantify on page 7 the impact of higher oil prices on the economy, we simply took the Fed's own model of the US economy, and we took models from the IMF and from the OECD and asked the question, in these frameworks and these models of the US economy, if you raise oil prices to around the current level of $110, $115 a barrel, this is for Brent oil, then what is the impact on the US economy, on GDP growth and on inflation? And that's what you see in the first and the second column, that GDP growth in the US would fall by 0.35. So in other words, this is a partial calculation of saying, if GDP growth in the US should be 2.5, how much will we subtract as a result of oil prices being higher? And the answer to that is a fairly small amount. That means that at the current level of oil prices, we're not worried that it's going to have a substantial impact on the outlook. But as you can see in the third column, if oil prices go up to $150 a barrel, and there are even forecasts out there of much higher oil prices, then the impact on GDP will be much higher, namely closer to 2%. And now we're suddenly talking about a significant risk of a double dip, because again, if the long run growth rate, or the growth rate that we should be at, is 2.5, if you subtract 1.75 from that, you get much closer to zero, and therefore much closer to a recession. So the risk here is that as oil prices, if they continue to go up, the higher is the risk that we could get into a double dip scenario. That's not what we expect, but given that it's so difficult to forecast oil prices and the situation in the Middle East, this is something we're watching, again, mainly through the auto sales numbers, but also through the impact that it has on consumers more broadly. So the bottom line on this risk, on the geopolitical risk, is that oil prices continue to be the main risk in terms of the outlook, and oil prices therefore are something we're watching very carefully, and the forces that affect oil prices are of course also very important to keep an eye on. Turning to the Japanese situation on page 9. One thing, of course, which is good, is that the situation at least seems to be stabilizing. It's incredibly difficult to forecast the nuclear situation, but at least as long as it continues to be relatively stable, we think that that at least the situation is not deteriorating. But what you see in the first chart here is to think about what will this situation of both what has happened and also what could happen going forward, what would that mean for US GDP growth? And the first thing to think about is, what is the share of Japan in world GDP? And as you can see here, that's just around 9%. And if you turn to the next page, you can see what is the share then of the areas that were affected by the tsunami and the earthquake and now the nuclear situation in the Japanese GDP. And if you look at the three regions that you have there at the top, you have that the severely damaged prefectures add up to less than 4% of Japanese GDP. So if Japanese GDP is 9% of world GDP, and the affected areas are 4% of Japanese GDP, you end up getting a very small number in terms of the impact of global growth, and therefore also the transmission channel to the US is fairly modest in terms of what the implications will be for GDP growth. Obviously, from an investing perspective on page 11, it becomes very important to ask, well, what are the implications for Japanese financial markets and for the Japanese economy? And one place to look here is to look at what happened at the January 1995 Kobe earthquake. What this chart shows you, first the industrial production is the bars, and you can see there was actually very little move down in industrial production after the earthquake in Kobe. It's almost difficult to see industrial production, so in that sense there was not a significant hit to the Japanese economy directly, but we did see a significant hit to the stock market, the blue line, and the blue line moved down and it troughed basically 6 months later, and then the stock market started to move up again. But one thing that's unique on page 12 about Japan is, of course, that to think about the consequences for Japan of the Kobe event, you also need to remember what Japan went through in the 1990s. And what you have here in the left-hand column shows you GDP growth in Japan in the 1990s. And as you can see, the two numbers that I have bolded in 95 and 96 shows you that you did have a significant increase in GDP from the rebuilding efforts in Japan in 95 and 96. But for the rest of the 90s, the Japanese GDP growth, unfortunately, was not particularly good. And that's, of course, the issue, that you did see a rebuild boost to GDP, and there's also a good chance that we could see that this time around. An important difference is that Japan today, the fiscal situation, unfortunately, is worse than what it was in the 90s. So that challenges, of course, the question of where can the resources come from to do the rebuilding. But the bottom line is that rebuilding after the Kobe event did have a significant impact on the Japanese economy. So therefore, over the next few years, we should also expect to see a positive effect on Japanese GDP as the rebuilding takes place. Turning finally to the third risk on page 14, namely the Eurozone risk. One thing which is very important is, of course, to think about the magnitude of the sovereign risk problem relative to the magnitude of the problems at the muni and state level in the US. Here you see debt to GDP in the blue bars for sovereigns or for nations, and the red bar shows you debt to GSP, gross state product. So this is basically telling you that this is not to say that there are not significant problems in New York, California, and Illinois, but it's just to tell you that the magnitude of the problems that you have at the sovereign level is just much more substantial. And that's of course something that also feeds into what you see on page 15, because there has been a very significant differentiation between what's happening in the several of the nations that have had fiscal problems. The chart here shows that the blue lines are the sovereign CDS spreads, meaning the risk of the Portuguese defaulting on their debt, and the red line is the same for Spain. They should not have gone down to zero. The lines remain very elevated. But the bottom line is that there's been a significant differentiation in the marketplace between Portugal and Spain. And Portugal is obviously undergoing some significant challenges at the moment, whereby they have just this week asked for help because they have got these significant fiscal problems. And specifically, they asked the European Union for help. Normally, a country in Europe that has gotten into trouble, specifically Greece and Ireland, have asked the IMF for help. But in this case, the situation is still developing as the Portuguese are trying to get their economy back on track. But the critical thing here is that in some sense there is no objective truth about which countries are in good shape and which are in bad shape. So a very important issue here is an attempt to try and differentiate those countries that need help and therefore will move in the right direction, and the other countries, in particular Spain and the rest of the core European countries, that do not need help. And we definitely think that Spain do not need help from the IMF, and that's why the Spanish economy will make it, but the Portuguese situation continues, unfortunately, to deteriorate quite substantially.
So can you comment on why they took so long to get help in Portugal, and are we likely to be surprised by Spain, even though the base case is exactly as you said, nobody thinks that they need help?
That's a very important question. I used to work at the IMF, which normally does these things and helps these countries in these situations. And it's clear that in many countries, it has been a matter of that the fiscal situation has just been deteriorating and deteriorating. And then at some point, the political establishment says, wow, now the situation is so bad that we need help. But the problem is that to get that help, you need to have conditions attached to that help. And that's why in many cases, politicians are very reluctant to ask for that help, because the conditionality, the conditions that often are associated with getting the help can be very politically unpopular. And that means that, for example, in the Greek case, a lot of the help has come with the conditions attached that they raise their retirement age, that they increase tax collection efforts, that they cut down expenditures on social programs and elsewhere in the economy, that they reform healthcare, that they reform the pension system, things that can be politically quite challenging to do in many economies. And that's why the challenge has been for politicians to find out when is the right time to call in help, or do I need to call in help at all? And there's no objective truth about this. That means that in some cases, countries have made it without asking for help because they simply just got back on track on their own. But in some cases, unfortunately, the ability, which essentially is what this is all about, the ability of countries to sell the government bonds in the market has just not been there, basically meaning that you got into a situation, if you couldn't finance your running expenditures, then you essentially needed to have help to make sure that you got investors back that wanted to buy your bonds eventually. And that's really what you have on the next page, namely the funding needs of many countries at the moment in Europe become very important from a timing perspective. What you see in this chart here is the rollover needs. So there's a rollover need, a funding need both for banks, there's also a funding need for sovereign balance sheets. And what you see in this chart is that the funding needs for Spain, Portugal and Ireland continue to be very substantial here, both in Q2, but also as we come into Q3 and Q4. So in a nutshell, this is another way of saying that if you have challenges selling your government bonds into the market, then in one way or the other, you have to probably do something to try and get interest rates down so that the cost of borrowing come down so that investors want to buy your bond again. And that's exactly the challenge that we have been watching, that Greece came first to the realization and came to the point where they asked for help, and then Ireland came to the point where they asked for help, and now Portugal has gotten to the point where they asked for help. The big difference here is that in our view, there's a huge issue in terms of the fundamentals of those three economies compared to, in your question, compared to Spain, which on its own have been doing very significant reforming, both of healthcare but also pension reform, and now they're thinking and working and moving forward on reforming of their banking sector. The problem is, for many of these countries, as it was for the US, that as asset prices came down, many banks were hit very substantially. So that's why recapitalization was needed in many cases. and recapitalization is, in our view, still needed in the Spanish case, and is moving forward. And that's also ultimately what we think also will bring confidence back. And I think that's an important reason also why you've seen this differentiation on page 15 again there between the marketplace saying that Spain is actually in better shape than what you see in particular in Portugal. Often then on page 17 you get the question, well, why don't these countries just default on their debt and move on? In many IMF cases, countries have just defaulted on their debt, with Argentina being one, and then that had, of course, caused a lot of problems for financial markets, but ultimately it created a situation where the economy basically could leave the problems behind and then start to move in the right direction. The problem is in the European area that if you look at the magnitude of government debt outstanding, then the main issue with a default is that if I borrow $100 from you and I end up saying I can only pay you 50, that means that you will have a loss of $50. The question is, in the European context, who will have that loss? Which balance sheets will have that loss if you do a default, or if you do a haircut, or if you basically do pay less back than what you originally planned? And the problem is, as you can see in this spaghetti bowl here, that the problem is that most of those assets, namely Greek, Irish, Portuguese, and Spanish government bonds, are either with the banks or the ECB, or to some extent also the EU and IMF. And that means that those balance sheets in the banks and at the ECB and also at the EU institutions that have these bonds, they need to be stronger and they need to be more recapitalized in order to absorb the loss that will come if you suddenly say that you can only pay back 50% of what you initially borrowed. So in that sense, the huge issue here is that you cannot just default on your debt because you risk that some of these institutions, and in the most extreme, you risk that the ECB, the European Central Bank, would become insolvent. So think about what that means. Imagine if the Fed became insolvent. That would basically create, of course, a lot of political issues and create a lot of issues around what is then the situation going forward. So that's why, in our view, a default in the near term does not seem likely, because the balance sheets that have to absorb those losses are unfortunately not quite yet strong enough. One thing that's important also, of course, to remember is that time is definitely helping here on page 18. What you see in this chart here is that the PMIs, meaning basically the ISM indicator for the European countries, again, this should not have gone down to zero, but they have basically been doing better, in particular in the euro area more broadly. The only exception here is Greece, where the economy is still lingering a bit because of the reforming that they are going through. On the next page, of course, you can ask the question, well, where does all this end? And one thing which is incredibly important, of course, is that fiscal rules, meaning how you design the fiscal rules and what entities and governments can do, is incredibly important. So one thing that has been relevant here more recently is, of course, to think about, well, at the old regime in the European Union, you were as a country not penalized if you basically ran up huge deficits and you ran up huge debt levels. So now, what is it that is on the table? And here you see what the German politicians have been saying here a few months ago, that the basic decision was for fiscal and budgetary policy to be decided at the national level. If that's to be changed, then we can talk about it. And in 10 years, we'll have a structure that corresponds much stronger to what the one describes as political union. So the Europeans are moving in the direction of changing and reforming the way that the setup is working. So we are not worried about this event, and again, the impact of this on the US economy is very, very small, but there is again a risk, which is mainly a political risk, that is about the willingness of continuing the integration of the European Union as we move forward. So turning now to the outlook for the US economy, summarizing basically these 3 points of geopolitical risk, oil prices, and Japan and the euro area, what does it mean for the US outlook, and how should we think about where the US economy is going? What you see on page 21 is first the simple observation that when you look at gasoline station sales as a percentage of all retail sales, then you have more recently, of course, as oil prices have started to go up, you have of course started to see a higher share of consumption go towards filling up your car. In 2008, you remember that oil prices were at $150 a barrel, and then they came crashing down. So of course there's been some significant fluctuations in how much of my consumption goes towards filling up my car. But more recently it's been crawling up to a fairly high level again. So again, this is one place where if I don't have $1 for consumption on normal goods, if you will, because I have to fill up my car, that's of course a negative for the outlook, and that's why again oil prices are directly affecting the GDP numbers. Turning to a more broader issue for the US economy, it's important to think about the outlook in terms of what oil prices do, but also in terms of what are the cyclical components of GDP, and that's the blue line here. One thing that's very unique about the US relative to almost any other country in the world, is that in the US, you basically have that the business cycle, meaning what moves the economy, is the blue line here, but the blue line only makes up about 20% of the US economy, whereas the red line, which is basically everything else, makes up 80%. So there's a huge difference in what drives the economy, because what drives the economy is essentially the blue line, namely the cyclical components of GDP. And what you see on the next page is the components of what's inside those cyclical components of GDP. In other words, what is the business cycle in the US economy? And the business cycle in the US economy is four things, namely the light blue one, which is essentially CapEx, business fixed equipment, investment equipment and software. So that's CapEx, meaning companies' investment decisions. It's the dark blue, which is essentially cars. So if I buy a car, it will help the GDP numbers. If fewer people buy cars, it will deteriorate or push the GDP numbers down. Over to the left, you have the red, which is non-residential structure. So think of this as commercial real estate. And you have the yellow, which is residential investment, meaning housing construction. So thinking about the outlook, geopolitical risks feeds in mainly here, again, through oil prices, which affects the light blue, and it affects also the dark blue. And it also affects residential investment because it means something for energy and the price of producing a home, and to a less extent, the red, therefore, and the yellow. But if I look at it from a business cycle perspective, a lot of this recovery that we have been through has really been a recovery in the blue side of this chart, namely CapEx and car sales. And that's what the chart that we looked at earlier, car sales have been going up and rebounding, and CapEx has also been going up and rebounding. But what has not rebounded yet is really, to a significant degree, the left side of this diagram here. So if we agree that the economy can really be described by what's happening to these four components of the economy, my worry is, the big question here, when will the housing market be good enough to start to add to GDP growth, both in terms of construction of new homes, but also in terms of construction of apartment buildings, shopping malls, and industrial complexes. And one issue that becomes very relevant when you think about the outlook is what you see on page 24, and that is namely the state and the health of the housing market. And the housing market, unfortunately, in the US continues to be affected by a significant amount of people that are in foreclosure. The dark blue line here shows you the number of housing units in foreclosure for the US overall, and that currently stands at around 2 million. And it's really interesting to look at this chart, because if you think about that, the housing crisis started in 2006, home prices started going down, and even 5 years later, we are still only at the peak in terms of foreclosures. This just tells you that clearing out the problems in the housing market, unfortunately, have taken a very long time. Still 5 years later, we are still only at the peak. And the risk is that we still may have at least a few more quarters of foreclosures being high, and then we should expect to see foreclosures start to come down. A very important driver of that is, of course, the unemployment rate. The key driver of whether people go into foreclosure or not is whether they have a job or not. So the unemployment rate coming down has been very helpful, but the difficult thing here is that the unemployment rate has come down a lot, but employment creation, unfortunately, has not been as strong, and we only had 216,000 jobs in the latest jobs report on last Friday. It's good, but we have to remember that has to be viewed in the light of employment in the US today is still more than 7 million jobs below where it was in 2007. So at a rate, if we create 200,000 jobs a month, it's going to take us a long time before we recreate the 7 million jobs that we lost since 2007.
When we had the massive stimulus, we heard a lot about how it was actually not going to have an immediate impact, that it was going to have an impact 2 years later because there weren't enough shovel-ready projects. And so when I look at your pie chart on page 23, isn't that the red slice, and shouldn't that start to move because of the stimulus?
That's true, and it has definitely had a lot of incentive programs to try and initiate more construction, both on commercial and residential real estate. The problem is, during a lot of the good years, we simply built too many homes, if you will. Relatively more homes were constructed than there were needed, at least relative to demographic trends. So in that sense, the oversupply that we had to work through has been so substantial that the home builders have unfortunately not quite yet, in other words, the red and the orange here, haven't really taken off, because we're still looking at a situation where the foreclosure stock and the excess inventory has been quite substantial.
So the red doesn't have bridges and tunnels and roads in it?
It does,
but that was the part that
absolutely, but those as a share of housing construction totally is a relatively small share compared to housing construction more broadly. And in that sense, it has definitely helped, meaning that the stimulus package was a huge boost, and in our view, definitely made sure that GDP growth didn't fall as much as it otherwise would have, that the economy definitely started to see much more upward momentum. But in terms of the government size and the government programs relative to the rest of the economy, it has not enabled or quite yet pushed the rest of the economy in the right direction. Another way to say this is to say that the government programs were good, but when we look at it now, they should probably have lasted even longer in terms of how big the problems have been.
Let me ask you something then. A lot of that stimulus money is trending downwards. I mean, it's basically going to slowly evaporate this year and next year, and that's been the biggest hit on the budgets in the states and municipalities. But one thing that's not touched on here, it's not just a matter of jobs, it's a matter of what those jobs pay, which create that stickiness in terms of how the market will move. If people can't afford, even though they have a job, they may not be able to afford paying their mortgage. So where has that trended? I didn't see a chart like that
Yeah,
with regards to
that-
payrolls and salaries.
It's a really good question, because during the crisis, the positive payroll numbers, the government was creating jobs and the private sector was shedding jobs. That, exactly to your point last Friday, and for the last few reports, we have seen a complete reversal of that. Now the private sector is creating jobs and the government is shedding jobs. It's fairly small amounts for the government, and hopefully we will continue to see the private sector create more and more jobs so that we can recreate the 7 million jobs that we lost in 2007. But you're absolutely right that this is a critical issue also when you look at wages. One thing that has been very prominent more recently is that wage inflation and therefore wage growth has just been coming down, and in the latest reports it's basically been flat, so there has not been wage growth in the economy when the unemployment rate is so high. And therefore, as you say, it's not only unemployed people, unfortunately, that are going into foreclosure, it's unfortunately also people who still have jobs, but where they just don't have the wages.
And
or the
getting
salaries.
back to your oil presentation about the cost per barrel, taking up more and more of the actual household budget, so to say. If the salaries don't go up, then that's actually going to be an even harder dent on the average budget, so that people won't be able to spend and get us out of this morass, so to say.
Absolutely, that's why it's I mean, the good news is that car sales, as we talked about earlier, have not seen that dent quite yet. But absolutely, this is a horse race between, we need employment numbers, we need companies to hire so that we can see employment numbers go up, and hopefully faster than what they have done up to this point. And the horse race then is against the countering effect that an unemployment rate at 8.8 is still very high, and the housing market is still having problems. It's sort of pulling in the other direction. So the quantification here is about which force is the strongest. Will we start to see companies hire much faster, and therefore that it will win the battle over the negative effects that we have still from the housing market and from the unemployment rate being so high? But in a nutshell, what you just outlined is at the center of my radar screen in how I think about the outlook, because that is exactly what we need to see. We need to see employment creation come back, and come back hopefully faster. And that's our prediction. It will, and Bernanke also has said this, that employment creation is likely to come back relatively strong in the next couple of quarters. But there are still some fairly structural underlying problems that we talk about here, including what you see on page 25, when you look at not only is the number of people that are in foreclosure unfortunately very high, but you also have that the shadow inventory, the people that are at risk of going into foreclosure, is fairly substantial. Meaning this chart here shows you to the left the total number of mortgages in the US is about 48 million or 47.8. Of those, subprime is 3.9. At the peak there was 6 million subprime borrowers, now they're 3.9. But the problem is, the second column, that the 60-day plus delinquency rate for subprime is unfortunately 40%. And if you multiply the first and the second column, then you quantify and ask the question, how many people are potentially at risk of going into foreclosure? And you see here, if you add 1.6 million plus 3.4, you get up that it's 5 million households that are more than 60 days behind on their payments. That's unfortunately a very high number. And the employment rate, meaning the labor market, again can help that, but the stock here is unfortunately something that's fairly significant. The good news is that this number, this is basically an artificial calculation, you could say, because this is asking who's at risk. We don't know if they eventually will go into foreclosure. This is just asking how many people are behind on their payments. And the reason why this 5 million number is relevant is because on the previous page we just saw that the stock of people in foreclosure is 2 million, and this tells you that there's 5 million that are at risk of going into foreclosure, and therefore substantially also, again, the most significant risk is putting downward pressure on home prices. So the reason why I bring this up is that there are, broadly speaking, two risks to the outlook. And the first is basically what I have here on page 26, geopolitical risks, meaning confidence deterioration, the CNN effect could magnify the negative effect on the economy. The second risk is foreclosures could start to increase again. This risk putting real downward pressure on home prices. And the third and final thing, which is a smaller issue, is that the commercial and residential real estate problem may weigh on small banks' balance sheets for a longer period, and this may hold bank credit small businesses, and this may keep the unemployment rate elevated. So those three risks are what I would call the macro risks that I worry about from a fundamental perspective. The upside risk is the final point I want to make in the outlook, and that is QE2 and what the Federal Reserve has done in response to these problems. In our view, home prices going down is of course something that the Federal Reserve can do very little about. They can try to lower interest rates, which is what they have done, and then they can do QE1 and QE2, which is an attempt to try and lower the mortgage rate. But the problem is that those efforts really haven't done much to home prices. Home prices still going down. But what it has done, and what has been incredibly helpful, is that if you think about consumers, they don't only have housing wealth, they also have financial wealth. So while you have seen home prices go down, you have actually seen stock markets go up. So the whole idea here in QE2, in our view, has to a large extent been that the Fed has said, well, if we can lift financial assets, then that can counter that home prices are going down, and maybe therefore hopefully not make the negative wealth effect on consumers and also on companies so significant. And that's exactly what we're seeing. The stock market has come back, and that has definitely dampened the negative effect of home prices declining. So at this stage, again, a lot of confidence is coming back because many investors are saying, wow, if 10-year treasuries are 3.5, I need to buy something else because that's not enough to pay my policyholders as a pension fund or insurance company. So that's why I have needed to buy something else, and that something else has been a more risky asset, which essentially has been US equities. The S&P 500 has probably been doing very well exactly for this reason, and to a large extent also emerging markets, and even commodities and other asset classes have probably also been doing well because people have said, I don't want to have fixed income anymore, at least for a while, so I need to buy something else in the meantime. So in that sense, that strategy of countering the negative force of home prices and thereby lifting other financial assets has been incredibly helpful, and in our view will continue to take place as long as QE2 is in effect. As you know, QE2 is about to end in June, so there could be some issues about whether the stock market could start to react to that again, but at least up to this point it has been incredibly helpful that the stock market has gone up as much when you have had home prices going down at the same time. Turning to final pages on investment implications, what would I recommend you to do? And this is just a summary of what I've been going through. I think we should keep an eye on oil prices mainly. Also, of course, the nuclear situation and the situation in Portugal. And finally, keep an eye on the sustainability of the US recovery, especially the ongoing recovery in the housing and banking sectors. And that basically leads me to page 29. What are the investment implications for different asset classes? What is the Fed outlook? I think the rate hike has been delayed. High oil prices are delaying the Fed hike. 600 billion in QE2 likely to be completed in full. Non-farm payrolls are likely to grow at plus 200,000 in the next couple of months. Bond markets, I think long rates will go up as the economy improves and QE2 ends. Long rates are close to fair value and are poised to rise later on the back of the recovery. And QE2 ending in June will signal that the Fed tightening cycle has begun. Once Europe solves its problems, US is likely to lose some of its safe haven status. Remember that many investors in Europe at the moment have basically said, I don't want to have too much of these Portuguese, Greek, and Irish government bonds. So instead, they're allocating less to that. And by definition, therefore, many of them are allocating more to US treasuries. But as European investors then start to fill up and buy more peripheral government bond, you should see some flows out of US treasuries. And that could put some upward pressure on rates when we get to that point. Stock markets, I think stock markets will continue to do well. The gradual recovery and the ongoing hunt for yield and risk bodes well for equities. FX, I think the dollar will go down. Expect a continued dollar decline once the European problems have been addressed. Commodities, I think, will go up, and emerging markets also will go up. And with that, I will basically stop there.
So given your presentation and your outlook on, for example, stocks going up, what asset and equity would you be looking at more trending upwards than the other assets? For example, small cap, maybe, large cap. Which would you see?
Yeah, normally in a business cycle, small caps do very well early on, and that's exactly also what we have seen. So to some extent, small caps have already outperformed where we are in the cycle. Some themes that I think that are very important for you to think about is exactly the themes of the housing market not having yet recovered. So home builders and basically everything, materials, everything that's related to housing construction has so far been underperforming. And that's of course one theme that has been out there for a long time, that people have been betting that home builders and the housing market would come back, and unfortunately has taken as sad as it exactly is, and unfortunately taking a very long time. So home builders haven't really been performing very well and have still underperforming relative to other sectors of the S&P 500. Financials are very linked. I didn't talk about that, but financials are very linked to the housing market because the decline in home prices means that those who hold those loans have asset losses because the credit quality is falling. So those asset losses, of course, have been feeding into banks' balance sheets, and that is probably also an important reason why the banking sector or financials have not been outperformed. So I think that's a major theme in terms of spending, and this is why I spend so much time on housing, that if you get the timing of the housing recovery right, then it will fall into places what sectors of the equity market will be benefiting from that. And it actually turns out that those are the sectors that exactly have not performed very well up to this point because the housing recovery has been so much weaker than what we and everyone else had anticipated. Yep.
So how exactly does the Fed exit their QE2 program, and number one, and number two, if it involves selling mortgage-backed securities, how does that impact housing prices?
This is a big headache at the Fed probably at the moment. As you know, they will have their meeting here at the end of April, and the QE2 ends in June. So far Bernanke has been saying, I don't think it's time to raise rates, where some of the regional presidents of the Feds have been saying, we think it's time to raise rates potentially already later this year. But the answer to your question, I think that they think about it in terms of we need to focus as the Fed on two things, and this is why Bernanke and Yellen and Dudley particularly talk about these two things, namely the unemployment rate and inflation. And it may be that the unemployment rate is coming down and inflation is starting to pick up, but if the underlying, the domino brick that has to fall first is housing and banking and the other structural issues we have here, if those dominoes haven't moved in the right direction, we are still holding off with signaling that we want to raise rates. So I think for them, it's a really walking on eggshells here, trying to find out how strong is this recovery in the economy, and will, when you come back to this red diagram that I had, will we start to see any contribution to GDP growth from this side over here, or will we still fly on the one engine, namely what we have seen over here? And this is incredibly difficult to quantify and find out, but I think that Bernanke and company are saying we would rather be safe than sorry. So we are rather safe and saying we want to wait until we are absolutely sure that this engine is also running. So I think for them, they will say, we will basically end QE2 as planned because the recovery is what they call on a firmer footing, but they're very cautious in signaling that they think that this is a green light for the economy to be back on track. Because if they go out tomorrow and say, we think this recovery is doing very well, then long rates will go up and short rates will also go up. And that may exactly dampen the whole purpose of this, namely the housing market and mortgage rates going up. And that's why I think also for selling MBS and running down their portfolio eventually, as you know, they have more than 2 trillion. They used to have only around 800 billion in assets. And it's very unusual for the Fed or a central bank to have that. But I think they will only do that when the economy is healthy enough to be able to absorb these substantial amounts that they have bought.
Any further questions?
Good?
Thank you very much.
Thank you.
Thanks very much.
Thank you.
Okay. Now we have GMO coming. GMO is an investment firm that spends a lot of time thinking about asset allocation. Very interesting presentation I saw it yesterday again. I think you guys will like it. What we do with it and how we actually implement it here is a whole other story, but again, as part of our let's think about asset allocation, I think this is interesting stuff. So, I don't know where they are.
But now you got the air blasting and
It's
I'm
good.
freezing.
She's hot. You guys have to negotiate. She's always hot at your call.
I'll take her jacket.
It rains where I sit.
It's cold.
It is cold, isn't it? We have this thin air is just blasting.
It's like a hurricane over here.
Seamus loving it, I know. Yeah.
I always thought it came right under.
I was in favor of the removal of the
It is
seats.
blasting.
For the record.
I can handle it.
Little kid's school.
Are we off mic?
No.
Short break.
We're taking a break?
The speaker that came to GMO, yes.
Okay, these are the GMO. State your names and you have about half an hour.
Okay. Thank you very much. We're pleased to be here. My name is Drew Tammany, and I have with me my colleague Matt Cadnar. We've been asked to talk for a few minutes, a half an hour, about what our firm does and our thoughts in asset allocation and why that's been important to us as a firm and to our clients for some on the order of 33 years now. So we'll do that. We encourage questions when you think they're appropriate. We can do it during or after, but we'd like to make it interactive as well, though it is a large crowd. Did everybody get a book? Okay. We'll probably use most of the pages in the book, maybe not all of them with a time constraint, but again, thanks for having us. Page 2 is one that I'd like to speak to just for a minute or two, and then we'll turn to Matt, who is the portfolio manager on many of the things we do in asset allocation, to talk about our asset allocation views and how they've been successful for our clients. Page 2 quickly talks about the firm. It's a firm that's the same firm we built in 1977. We manage money for institutions only. You can't buy what we do in a retail way, even though we manage through the use of a lot of mutual funds. They're institutional mutual funds. I won't spend too much time on the exhibit. I think it's kind of a self-read, how we're organized and what's important to us. And to be honest, I bet not too many managers come by and tell you that they're undisciplined investors. So that's a kind of a Me Too thought there, that we're disciplined investors. But what's not Me Too is just institutions, 100 billion of assets, and some 40% of that managed through asset allocation mandates, in which people will give us $100, and the first decision is which markets to put it in, rather than which stocks or bonds to put it in. That's very important to the decision-making process at GMO, particularly with the 40 billion that we have in asset allocation. Are there questions on that quick review of the firm in some 33 years? If not, again, we've been asked just to come by and in an educational way, just talk about asset allocation as we see it at GMO. So for that, I turn to Matt Cadnar to introduce page 3.
Thanks, Drew. Page 3, we're going to start our discussion with an incredibly important force within the world of institutional investment management, or asset management in general. And it's an area that's not talked about a whole lot. It's quite simply career risk. And so this whole slide is actually taken from a book by the English economist John Maynard Keynes in 1936. It was equally true then as it is now. And Keynes talked about career risk. He said, the career risk is essentially that people behave as if their sole job is to keep their job. Their job description is to not get fired. Their job is to keep their job. And so how you do that is that you're never, ever, ever wrong on your own. That you can be wrong with your peers, that's perfectly acceptable, but you never want to be out there on a limb all by yourself. That's how you get fired. And he had a great quote. He talked about bankers, and he said a sound banker isn't someone who foresees danger and avoids it. It's the person who is ruined, but he's ruined in a conventional and orthodox way along with his fellows, so that nobody can really blame him. And if you think about the events of the past couple of years, that's exactly what happened on Wall Street. And so how do you keep your job other than not going out on the limb? Well, you look around and you act just like the guy next to you. And all you try and do is you try and beat him to the draw. You want to be a little bit quicker, a little bit slicker than he is, and that's how you keep your job. Chuck Prince from Citigroup, he got this message. His famous quote, he's going to keep dancing as long as they keep playing the music. Well, unfortunately, he wasn't as quick as slick as the next guy. The music stopped, he couldn't find the chair, he ended up getting fired. But that's how our business works, and that's how you keep your job. And so the natural result of this is that you have herding, that you look what everyone else is doing, and there's Me Too. Everybody's getting into private equity, so let's get into private equity. That creates momentum. So you have herding and momentum. Momentum is an incredibly powerful force within financial markets. It's there across all markets, across all times. And right along the way, as you get that momentum, you have Wall Street shuffling you along the way. Wall Street perpetuates this. Whenever you get to the top of a market, Wall Street will always go out, some smart
smart person will come to you with a very elegant explanation as to why it is different this time. But the reality is, it's almost never different this time. So this type of behavior creates inefficiencies as markets get pulled away from their fair value. But there's an underlying reality to investing, and that's replacement cost, the intrinsic value. That an asset, you own a stock or a bond, you own it for one reason. That's to deliver a rate of return. When that rate of return becomes very low relative to its intrinsic value, eventually the market realizes this. It can take a long time. The S&P at 35 times earnings, Japan at 60 times earnings, NASDAQ at 70 times earnings. But the market eventually gets it to the point where they drive those prices down through fair value, where assets spend about 1% of their time till they become cheap again. And then we start this cycle all over. It's what the business cycle demands, it's what capitalism demands. And you can take advantage of it, make a great deal of money by betting on those assets coming back down to earth, or those assets avoiding those expensive assets. The difficulty with it is that the timing of that kind of return to fair value is inherently uncertain. There's no rhyme or reason for it. Why in March of 2000 did people realize that, XYZ.com and clicks to price to eyeballs or price to clicks or whatever those metrics they were using back then? Why did they realize that wasn't going to work? Who knows? It's the animal spirits of the market. And so how we handle that is we wait until markets reach extremes and then we step in and make bets. But this certainly can try the client's patience. That you have to have a long-term time horizons. Clients have to understand what you're doing and why you're doing it. And in order to do this, you have to be in a firm that's privately held. That a public firm can't withstand this type of investment process. But we believe that herding, momentum, extrapolations, create inefficiencies in the market that you can arbitrage over time if you have the right time horizon. So with that as a background, we've developed 7 laws that we believe that investors, or certainly we, try and follow. First, you always insist on a margin of safety. B, this time it's never different. Be patient, wait for the fat pitch. Be contrarian. Risk is not a number, it's a permanent loss of capital. Be leery of leverage, and never invest in anything that you don't understand. So for margin of safety, this is as an exhibit my colleague James Montier created, and he's waited a decade to be able to use this exhibit. In the summer of 2000, Fortune magazine comes out and they tell you what stocks that you should own for the next 10 years. The thesis of the article is you should own these stocks and then you should forget about them. And then in 2010, you'll wake up and be rich. Well, they got part of it right. If you own these stocks, then you'd want to forget about them. Because if you invested $100 in these 10 stocks equally in 2000, you'd wake up in 2010 with $30. Your capital is permanently impaired. Nortel, bagel. Enron, bagel. You're not getting that money back because you invested in these stocks when they're at 350 times earnings. There's no margin of safety there. And if you think back to 2000, investing in a portfolio of these names, it was easy to do. You're at soccer practice, you're talking to whomever, you're telling them how smart you are by investing in these names. It's easy to do, but investing inherently is not easy. Psychologically, it should be difficult. And if there's ever an investment that you have that you believe it's easy, be very concerned, because things are almost never easy. Page 6 looks at margin of safety for the S&P 500, kind of where we are today. And we're looking here at a Graham and Dodd PE, so it's a price to 10-year trailing earnings. I think one of the mistakes that investors make is they look at PEs and they look at 1-year trailing earnings or 1-year forward earnings, but that doesn't take into account the fact that earnings are cyclical. So when you're in the top of a bull market or the economy's doing well, your earnings, your denominator in that PE ratio is going to be artificially high, and that's going to make stocks appear artificially cheap. Your PE ratio is going to be lower than what it really should be. And conversely, when you're in a recession, earnings are bombed out, your PE ratio, your denominator is going to be very low, so stocks are going to be more expensive than what they are. And so here we're trying to smooth that out by averaging earnings out over 10 years. And so this is a lovely time series going back to the Chester A. Arthur administration, and you know, we're, to a certain extent, we're economic historians. We believe that this data is relevant because markets and economies evolve very slowly over time. So if you look at where we are today, we are at a PE of about 23 or 24. We are in the most expensive 10% of history. Other than our more recent history, the only other times the stock market has been this cheap is in 1965 or 1929. Those are comparisons that don't fill me with a great deal of joy when I look at this chart. The average return when you are in this most expensive 10% period of history is 1% over the next 10 years. There's no margin of safety. So this is one way to value the market. We create a 7-year asset class forecast, trying to do a similar thing, trying to adjust that PE ratio, but we do it a bit differently. We have PEs and profit margins that represent valuation, and then we have growth, and we have income, what you'd expect to receive by being an equity owner. Today, as we look at that 1 year trailing PE, it's at 18. We think a fair PE for the market is 15. As that PE comes from 18 to 15, smoothly over 7 years, it's going to cost you 2.6% a year for the 7 years. At the end of the 7 years, the market will be priced at fair value. Secondly, we have profit margins. Profit margins are around post-World War II cyclical highs. And we believe profit margins, if capitalism is working, profit margins can't stay high. They come back down to earth. And so as those profit margins come back in, that's going to cost you 3.2% a year for the next 7 years. Then at the end of the period, the market's going to be priced at fair value. Now you get some growth, you get some income along the way. The growth has been decimated through the recession, so we think you're going to get higher growth than you've had historically as things kind of rebound. Then you're going to get some dividends a little bit higher than what we've seen historically. But you put those together and you get a forecast of minus 1% real, so minus 1% plus inflation a year for the next 7 years. And you may quarrel with this, and you can say, I don't agree with this. But the only way to make the markets cheap is to say a fair PE in the market isn't 15, it's 20 or 22. We have a hard time believing that. It was a lot easier to believe that in 2000. We think that that's been dispatched. Or you can say profit margins at post-World War II cyclical peaks, they're going to go higher. They're going to go to 8.5 or 9%. That's actually what Wall Street is forecasting right now. But if you believe that, then you really believe that things are different this time. Obviously, that's not something that we're comfortable with. So on several different valuation metrics, we think the S&P is expensive. I'm going to skip over bonds in the interest of time and come back to that later and address the question of, this time it's different. So page 10 shows 12 of 28 asset class bubbles that we established in history going back to the South Sea bubble in the 18th century. So my boss actually created this chart in 1998 when GMO as a firm didn't own growth stocks. They didn't own tech or internet or media stocks. We owned REITs, we owned emerging equities, and we owned small cap value. And our firm was fighting for its proverbial life. And all we heard from clients were, this time it's different. You just don't understand. So we went out and we found every asset class bubble we could get our hands on. 28 of them in the history books. And out of those 28 asset class bubbles, at the time, 27 had risen to new peaks and 2 standard deviations from their long-term trend, or 100% move in a capital market. And out of those 28 bubbles, 27 of them had come back down to earth. There was only one that had not. And in 1998, that was the S&P 500 in the upper right-hand corner. We got pretty close back to that trend line in the fall of 2002 and the spring of 2003. We had what at that time was unprecedented monetary and fiscal stimulus lift us off the bottom until we got to the fall of 2008. There's always a chance that it's different. And since this time we've done this study further, and we think on average there is a paradigm shift where it's different once out of every 200 years. So those are the odds that you're betting on if you're telling me that it's different this time. This also represents, these bubbles also represent tremendous opportunity. They represent opportunities to make a lot of money, and and avoid losing a lot of money. And you need to be patient. You need to wait for the fat pitch as they come along. And so if we flip to the next page, this is our asset class, that 7-year forecast. We actually used to create a 10-year forecast several years ago. And this was our forecast as of December 1999. We thought REITs, emerging equity, and emerging country debt were the 3 most attractive asset classes. And our forecast for the S&P 500 was a return of minus 1.9 real for the next 10 years. And so every dollar that you put in emerging equities, which delivered 8.1 real, versus every dollar that you put in the S&P 500, which was down 3.5, emerging outperformed by 300%. Those are the types of opportunities that we're talking about. Those are the fat pitches that you need to wait for when you have enormous divergences within markets, which, by the way, emerging markets in the S&P 500 grew, their correlation only increased during that time, but you still had enormous divergences in those overall returns. And clients spend so much of their time trying to go out and pick the best small cap value manager. How many small cap value managers do you have to pick with their imputed 200 basis points of alpha to equal a 300% move in the market? The markets don't give you these opportunities all the time. They come across every now and then, and when you see them, you have to swing hard. And guess what? Owning, going to a cocktail party and talking about being long emerging equities and REITs in 1999, you're not the most popular person there. Again, it's not comfortable to do, but that's how the money is made. So as we think about what's comfortable to do right now, page 12 shows, this is a Merrill Lynch has their survey of investment managers, and we're going to focus on these light blue bars. The light blue bar shows the percent of equity managers right now that are overweight equities. It's the highest it's been since they started doing this back in 2000, over 60%. Everyone loves equities. It's easy to be overweight equities. And what does everybody hate? Everybody hates cash. Managers are more underweight cash. They're about underweight cash as they were in the stock market, the bear market, 2001 and 2002. Nobody wants to own it because markets have been going up. This is career risk. Owning cash is tough. It's how you get fired, so nobody wants to do it. And that's where the opportunity is.
It wasn't here an hour ago.
2 is not a 20, guys.
Cash is the ultimate in career risk. It gives you, but what it does, it gives you the flexibility to invest when things are cheaper. And in 2008, that was so incredibly important. And a couple of years later, it's largely been forgotten. It's passé. But we do have a very different view of risk. We think risk is not beta, it's not volatility, and it most certainly is never a number. Risk is losing your money and never getting it back. There are 3 ways to do it. There's valuation risk. You buy the S&P 500 in 2000 at 35 times your money. That's valuation risk. You're paying for an expensive asset. It takes years for that asset to recoup the lost, to grow its earnings and incomes in order to recoup that exorbitant price that you paid for it. There's also fundamental risk. Ben Graham, the father of value investing, he talked about, real risk is not that the stock goes down. The risk is that losing the quality and earnings power through economic change or deterioration in management. You bought something that you thought was cheap, something changed, and your E evaporated. Your E went down, you weren't expecting to it. That's fundamental risk. And then lastly, financing or leverage risk. Leverage is tough. It's good when things are going up. It's not so good when things are going down. Leverage can never make a bad bet good, but it's made many good bets bad. So when we think about risk, we think first and foremost, if something goes down, we buy more. We check the fundamentals. We do our homework. We understand why things are going down. If it goes down, we buy more. If it goes down further, we'll buy more. And then eventually, if we're right, mean reversion comes and we get back what we lost with interest. It's never fun, but that's how you go about making money. 15 shows. 15 is another way to look at risk in this framework. Page 15 shows, this is a graph of our GMO Global Balanced Mutual Fund. The mutual fund started in 1996. We've been actually managing balanced portfolios since the late 80s, but this is the performance of the mutual fund versus benchmark since 1996. And you see that dotted line. During that dotted line, the benchmark was up 83%, and we were up 55%. And our asset base basically got cut in half. We went from $30 billion to $20 billion in the greatest bull market in a century. It's not easy to do, but we have the war wounds for it. And so we were getting fired at that point, and eventually things started coming back our way, and we ended up far outpacing the benchmark. We beat the benchmark by 2% over this period, but as you can see in the chart down below, we did it with 10.6% volatility versus the benchmark at 13.7% volatility. We did it, we beat it handily by taking less risk. We will gladly take tracking error around the stated benchmark if we can deliver less absolute volatility over time. We give them a smoother ride. We want to give clients a smoother ride. That gives you greater opportunity to compound your money. The real trick, however, is in 1999, hanging on to every last client that you can. Because this type of investment strategy only works if you get to the finish line with the same people you started with. Yes, ma'am?
So what's the biggest one-year drawdown you've had on this product?
In absolute or relative terms?
Absolute.
So that was in 2008, the portfolio was down kind of 24% versus the benchmark, which was down 32%. But we've had even larger relative drawdowns. Even though we were making money in absolute terms, we were underperforming our benchmark by larger amounts.
So that dotted line on that chart, 15, is when we put together the bubble chart that Matt showed you earlier, because our clients said, GMO, you've lost your touch. This time it's different. That's where we lost a lot of clients. But we stuck to our knitting. Because we're a private firm, we said, this tech market is pretty crazy stuff, we're gonna stay away. And we were nimble enough to do that.
So let's, we talked a little bit about leverage before. Page 16 just shows a chart of long-term capital management. You know, the hedge fund in Greenwich, they had a couple Nobel Prize winners. They had the Solomon prop desk. Those guys were the smartest guys in the room for a long time. They took $1, turned it into $4 over 4 years. Then they turned it into a couple quarters over a couple weeks in 1998 because they were so leveraged. They had the right bets on. Their bets made money, but they had so much leverage that they weren't able to hold on to them, and they ended up permanently impairing the capital, and they lost. You know, they took everything from $4 back down to 50 cents. Be very leery of leverage. And then the last law. This is a slide that we kept our graphics department up overnight creating this last slide. But quite simply, you don't invest in something you don't understand, or if it's too good to be true, it's not. The people that fortunate folks that invested in Madoff, they had no idea how he was making his money, and now we know. So what does this all mean to you? Where do we kind of go from here? Well, I think there's 3 lessons that we want to cull from this. First is breadth. We want to take advantage, or you as a plan want to take advantage of as many opportunities as you can to take advantage of these opportunities, to take advantage of mean reversion across as many assets as you quite possibly can. And then when you get those great opportunities, you need to swing hard. You need to step in and go overweight and do some things that are uncomfortable, but you need to make hay when the sun shines, as they say. And then lastly, you can't be afraid to hold cash. That valuation risk of investing in assets that are overvalued. And we recognize that as a committee structure, what we are proposing here is incredibly tough to do. And that's actually, this is how we make our living, that we take these risks, that we take the risk of being stupid. Because it's hard for committees to act according to this framework. But it's what our clients asked us to do, and it's what we've been trying to do for over 35 years at the firm. So just a couple comments on current positioning. You've certainly got a flavor of our view from some of the earlier charts. On page 20, we have our 7-year asset class forecast. This is the primary input in terms of how we put together portfolios. And so when we look around the world, we see the S&P 500, essentially 0 return for the next 7 years. That's certainly not in the brochure when you sign up to buy your Vanguard 500 fund. But that's what our valuation works tells us. Small cap is the most expensive that it's ever been. Equities were incredibly overvalued in 2007, but small cap had not reached these heights, or these depths, I should say. We do like U.S. high-quality blue chip stocks in a relative basis. So these are large cap blue chip names, pharma, names like Pfizer, Johnson & Johnson, Coca-Cola, Pepsi, Procter & Gamble, kind of boring, statal blue chips. And yesterday's darlings from the tech world, Microsoft. I was going to say Enron, but not Enron. Oracle, Cisco. These stocks are very cheap. They have a ton of cash on the balance sheet. And we think that they represent a great opportunity. But quality is not cheap in an absolute sense, but it certainly is cheap in a relative sense. The international equity markets, they're a little bit better than the S&P by 500, but that's really not saying a whole hell of a lot. And then you have emerging equities at 4.7 real. We've been doing a ton of work on emerging. Emerging trades at a discount relative to the developed world. We don't love emerging because we think China's going to grow at 9% GDP. Forever. That actually scares us more than anything else. We are very worried about China. We're very worried about their banking system. We're very worried about the property bubble that they have there. But emerging as a whole, even taking some of these things into account, emerging trades more cheaply than the S&P 500 and the EFA markets do. And then bonds, it is tough to love a 10-year treasury at 3.5%, given that yield, and also given the amount of debt the U.S. government has. When you have a great deal of debt, you can do 3 things with it. You can either pay it back, which is not a great deal of fun. You can default on it, which has some bad implications, or you can try and inflate it away. And that's, right now you're not getting paid much for that inflation risk, so we don't like government bonds. And then you can see cash at minus 70 basis points. Owning cash, it is like chewing glass. 5 basis points on a treasury bill is not going to pay anybody's pension. But it gives you the flexibility to reinvest when assets are cheaper later on. And that is incredibly powerful. We have timber here on the far right. It's a liquid asset class. We just kind of put it in there for comparison at 6%. But even, quite frankly, timber at 6%. You're locking your money up for 10 years. It's better than everything else, but it's not saying a great deal. GMO has always been known as being a bearish firm, or a firm. We always think the world is the glass is half empty, and I think that's incredibly unfair. We're bearish when the S&P 500 if it's overvalued. We've been bullish on a ton of things over the past 10 years, and here we have our forecast. Back in September of 2007, at the lows of the market of 2009, and then currently. So back in 2007, we thought equities everywhere were overvalued. The only place that we thought you could get a positive return was in high quality. So Drew and I would go out, we would do pitches to clients, global equity portfolios, and we would show them that we believed that they were going to invest with us and deliver a negative return over 7 years. It wasn't a great deal of fun, particularly if their company was in the S&P 500. But that's what our work showed, and it's what we believed, and we're generally going to call it the way we see it. So we had the equity markets in the depth of the market in 2009. Stock market falls, 50-60%. Things get cheap. So our forecast at the depth of the market was 8.9 real for the S&P 500. Quality at 12.7 real, emerging at 11 real. And we bought an awful lot of equities in October of 2008, November of 2008, and then again in March of 2009. And I got to tell you, it didn't feel good at the time, but it was the right thing to do. We made a fair amount of dough. Now, as we sit, the equity market's up 100%. So what happens? Stock market goes up, our forecasts, again, are looking pretty thin. Not as thin as they were in 2007, but there's a couple places where we think there's some relative value to hide, but things are not cheap in an absolute sense. And each day the market crawls up, we get more and more worried. I guess ultimately, the message is that valuation really matters. And when the market swings around, you gotta move your assets, because it's a time to make a lot of money or it's a time to avoid losing a lot of money. And that's what we wanna focus on. And so I think I'm just gonna conclude, given that we're up on a half hour, on page 22 with our global balance portfolio, kind of where we are today. So we have our benchmark on the left, our asset allocation decisions in the middle, and then the ultimate allocation on the far right. So if you would apply our forecast to the benchmark, that yellow box shows that you would produce a return of 1.1 real, so 1.1 plus inflation, annually over 7 years with a volatility of 10.5 and a beta of 0.5. You layer in our asset allocation decisions and our assumptions for our alpha, what we think we can be the benchmark by, and we can gin those returns up to 4.1 real with lower volatility and a lower beta. And so this is our portfolio as the end of February. We actually sold a bunch of equities in the beginning of the month, so we're about 5% underweight equities at this point in the cycle. And by way of comparison, right before we made that move to buy equities, that first tranche back in the fall of 2008, we had about 40% of this portfolio in equities. We do have tracking error constraints in this portfolio that we want to pay attention to, because we want to, tracking error, clients can only take so much of it, so we want to be cognizant of it, but also balance the absolute risk. So we own a bunch of quality. We actually bought a bunch of Japan over the past couple weeks because the forecast from Japan went from 2.1 real to 6 real at the bottom. So all of a sudden we had a market that was trading at right around fair value. So we put money to work. On the bond side, we own no U.S. nominal bonds. We own a little bit of inflation index bonds. We own some high quality asset backs. And then we have this other category at the bottom. And that essentially is cash and cash plus strategies that for us represents dry powder. That is what we're going to rely on when the world eventually does mean revert. When the S&P's fair value right now is about 900. So if the market were to move back there, we would start deploying that capital and buying assets at levels that we think are much more reasonable.
Do you have expected returns the same way for these various bond categories, and could you send those on to us?
Yes. We don't do everything, but we have 13 cash and bond markets we can send you.
Pretty significant non-treasury bet, right?
Yes.
I'm trying to understand.
Yes. And a non-corporate credit bet as well. A big bet against corporate credit as well.
So let me finish on 23, make sure we have some time for questions. But 22 is a snapshot. Prior to that, you saw 3 points in time what we thought about asset classes. What did we do with that over a long period of time? 23 shows you that we're nimble, that we think, Matt and his team 24/7, they think about asset allocation decisions. We will make moves in this portfolio and in portfolios for clients, but it's not like this is day trading either. It happens at a pretty glacial pace, unless you have an event such as we had back in February of '09. Then we're really gonna pile into those markets. So we're well diversified in what we do in asset allocation. We're only gonna buy things that are cheap. And here is, I guess, sort of the movie of what we've done way back to '96 to date. All the different things that we've invested in for our clients.
And we move when the valuations move. It's about as simple as that. And we want to be compensated for taking risk. And when we get compensated well, we'll take as much tracking error as our clients will allow, because we think that's the opportunity to make a lot of money. And we care a great deal about avoiding losing a lot of money. 08, we were very glad to beat the benchmark by as much as we did. The issue that we had in 08 is there was nowhere to hide. There were no assets that we could find refuge in that we thought were going to deliver a decent rate of return. We took as little risk as we could, staying within those overall tracking error constraints.
What's inside Alpha Only?
Alpha Only is what we lovingly call a poor man's hedge fund. It doesn't have leverage or the fees of hedge funds, but essentially you take $1, you go out and you go buy 90 cents of GMO mutual funds, our US Core Fund, our US Quality Fund, our International Value, or International Growth Fund, and then you hedge out their benchmarks. So the US Core Fund and the US Quality Fund, we will go out and short the S&P 500. So what you're left with is you get the cash return from being short, and then whatever our funds can beat their benchmark by. So it's designed to deliver cash plus 100 basis points, and historically has done very well in down markets in protecting and preserving capital. So that specifically is the dry powder that we are counting on to be there to reinvest at cheaper levels.
And you guys like timber?
We like timber in a relative sense, right? You know, if you're getting paid 6 real, that's okay. Truth be told, if I'm locking up my money for 10 years and I say that fair value for large cap equities is 5.7 real, in a perfect world, I want to get paid a couple points on top of that for that illiquidity. And you're getting paid relative to the S&P 500, but in an absolute sense, it's not, it's tolerable, but it's not a bargain.
So going back to page 21 then, that is the sort of relevant point, right? Which is your dashed red lines is sort of a long-term equilibrium where if you were either A, fair value across the board, or B, if you had a really long time horizon, those are the numbers you should be thinking about, right?
Exactly. So, you know, it's difficult because the most recent history kind of skews us in that outside of a couple weeks, you know, we spent 15 years with the S&P overvalued, and we spent about 15 weeks with the S&P actually cheap. And then the market went up, and those forecasts came back down. And as we move further and further away from that fair value, you're reaching greater extremes, and so you want to start taking bigger bets against those assets as they become more expensive. But I do marvel that you know, the S&P 500 can rally 100%, and if an equity manager came in here and said, you know, if a stock in my portfolio is up 100%, you know, it doesn't change my outlook on the stock. I think I still like it as much as I did 100% ago. I mean, that's generally not done. But the S&P 500 is no different. That if you have 100% move in an asset class, its valuations change. What you can expect to receive from that asset class will change. And as you have those diversified portfolio, as those opportunities come along, you know, you need to buy them with both fists.
Any other questions? Good. Thanks.
Thank you very much for your attention. Hope it was useful. Thanks.
Okay. Again, more on asset allocation next month. I'll try to move the ball forward, working with Barry.
One
Barry?
second, please.
Someone what? Yep. Doesn't matter. You have the net. She's the one that counts, not the count.
I understand.
Go ahead. Sorry.
Barry, before I switch to Martin, have any thoughts on GMO? What they're yakking about?
Well,
As opposed to everybody else's.
Yeah.
It's a firm that in order to hire, you have to be like they are. You have to be patient and contrarian, which means you have to take money away from them after they've done well in this bad market, and you have to give them money when they're doing very poorly. And very few institutional investors can adopt that behavior pattern.
Isn't that the key to everything?
You have to be
Why
contrarian.
so why go so high?
Be contrarian with a contrarian, and that is contrarian squared.
You have to hold it long enough to make money, so get to that point. Even a broke clock is right twice a day.
But we like the firm for the right.
We like it at the right time.
Yeah.
Okay. The right time. Is it the right time?
Right now, I am very enamored with their quality bet.
Quality.
I think we hired GMO where Janice used to work.
Yes.
And the teachers have the GTAA portfolios, variables.
Okay. If you go back to our original asset allocation, you know, we're 70-30, right, equities and debt. And of the 30, 20 is in investment grade mortgages and governments. So it's all stuff that's not yielding us very much at all. And the markets are about to move somewhere in the future. The bond rates are going to go back up. No one knows when, but sooner rather than later. And we really don't have any way to make money doing that. And again, we're not nimble. We have managers in silos. And Martin's been working for a few months with Addie. You all met Addie? Addie here?
He's on his way.
He'll be back.
Well, missed his introduction. Curtain call later. On a plan to have more money in the opportunistic bucket that we already have and make the opportunistic bucket bigger, as we're going to talk about in the asset allocation next month or Monday. So Martin's going to walk you through a presentation we're working on. It kind of puts it all into context, but there's no investment recommendation. It's more thinking than anything else.
Okay, so we have a color version that went around. Hopefully you have that. But if you want to look in the book, it's on page 58 in the agenda package, but I prefer the color version. And as Larry mentioned, in this presentation, we are going to be recommending ultimately an increase in the size of the opportunistic fixed income program, as well as some new types or way of thinking of making investments in this program. And I want you to think back and recall back in 2008, the opportunistic fixed income program was established in order to offer the fund investments outside of the traditional investment grade and high yield programs that we have. So if you turn to page 2 of the presentation, you'll see a big pie chart. And the pie chart approximates the investable universe of fixed income investments. And the present Core Plus 5 investment grade program, the high yield programs, the traditional fixed income programs that we're in are shown on the right side of the page. These are the traditional fixed income sectors and are mostly public market securities, and they represent nearly 30% of the fund's assets. And as Larry just mentioned before, these are siloed or given to specialist managers with very little flexibility outside of their specific mandates. On the other hand, on the left side of the chart, you see that about 40% of the fixed income market, which is a very large opportunity set, falls outside of these programs, and this includes distressed debt, many securitized markets, structured products, and also private debt. So the opportunistic fixed income program was established to consider investments in the categories that you see on the left. On page 3, we note that fixed income, why is fixed income in the portfolio? It's there because it offers diversification to equities, and it also offers current income. However, the present market conditions that we're in right now are offering historically low yields and tight spreads. To give you some context, the present Core Plus 5, which is your investment grade program, approximately 20% of the portfolio, as of April 1st, has a yield to maturity of 3.5%. The high yield portfolio, which is about 4 or 5% of the portfolio, has a yield to maturity of less than 7%. On an historical basis, this is very low, and certainly for high yield, it's not really very high. In the opportunistic fixed income space, due to the illiquidity, the inefficiencies, and specialized knowledge that's needed for these investments, investors can achieve a higher expected return. On page 4, we show the opportunistic investments that we've made to date, and there have been some. The good news is that each one of them have done well, and the returns range from 12 or 13% all the way up to nearly 50%. The investments, however, have all been in specific funds that were targeted to institutional investors, and each fund is in a specific niche or a specialized area, such as RMBS, CMBS, distressed senior debt, or the PPIP funds in the case of the last bullet point. We have a very interesting chart.
We also had a fund that gave money back very early on.
That was in the private equity bucket at the time.
At the time, that was in the private equity bucket.
Correct. So we have an interesting chart on page 5, and this is a fixed income yield chart for several different areas in fixed income that goes back 10 years. And in most cases, you'll note that the yields have come down to very, very low levels that are not attractive on a historical basis. If you look at the chart, most of the fixed income assets that we're in now are near the lowest lines. In other words, the bottom 2 lines on the right side of the page, shown in blue or green. You've heard of treasuries, U.S. treasuries being referred to as risk-free yields, but in this case, it's more appropriate to be calling this yield-free risk, because while they're high quality and they're very liquid, with the tight spreads and low ultimate yields, any increase in interest rates will decrease the price of these securities, and there's very little margin with the yields that we're getting. And if there's any unexpected inflation, that will reduce the level of returns as well. But there is opportunity to make money in fixed income. So if you turn to the next page, page 6, you'll see that we list some of the potential opportunistic investments. And they include public market distressed securities, many private market securities, including the potential to purchase securities from banks that need to recapitalize. There is no free lunch, though. You just don't earn a higher return and live happily ever after. There is, of course, an exchange in getting the higher return. There are higher risks, and in this case, the higher risks are noted on the next page. First and foremost would be higher volatility. Although in most cases, the volatility that we would have in the opportunistic fixed income program is still lower than the equity market volatility. In addition, many of these investments are illiquid and are private market transactions. On the positive side, having said the negative side, many of the opportunistic fixed income investments offer better protection for the investors, such as better covenants, better collateral. In the case of senior debt, you have a senior claim on assets in a restructuring. And so this protects and gives you downside protection in the event something goes wrong. While the Core Plus 5 program and high yield, to a lesser extent, is higher quality and more liquid, there is significant duration risk or interest rate risk. And so we've heard economists come in every quarter talking about the potential that at some point rates are going up. And when rates go up, even in high quality fixed income, the return's going to go down. And because you have very little cushion in the way of yields, the potential for negative returns in fixed income is there. In opportunistic fixed income, specifically in distressed debt or floating rate notes or private transactions, there is very little interest rate sensitivity. What you do have is credit risk, liquidity risk, and some of the other risks listed on page 7. On page 8, we recommend what Larry said before and what I started with, and that is due to the low expected returns going forward, and this is not just now, it's going forward over the next 5 years, we would recommend an increase to the allocation to the opportunistic fixed income program from its present level, which is 1.5% of the total fund. The exact amount of the increase will of course be determined with the consultant and the board when we conclude our asset allocation process, but we should expect something in the 3 to 5% range, up from where we are now. And in addition to the increase, and this is very important, we're working on a plan with staff and consultants to bring to the board investments in this opportunistic fixed income space that are strategic mandates with specialized firms that will partner with those firms to create accounts that give the managers flexibility to invest in different areas in fixed income and the credit market space. We'll call these core mandates. In these core mandates, the manager will have the flexibility to move where the real opportunities are. These also will be separate accounts. Unlike the funds that we're in, these will be separate accounts where we control the assets. There'll be better transparency, lower fees, and better terms. And so the managers will have more efficient ability to move in a nimble way. In short, in this in these special mandates that we'll have with these firms that we're partnering with, we'll have better control over the assets, a better alignment of interests, and it will allow the managers to be truly opportunistic. One of the concerns that you have in an opportunistic fund that you go into is that you make the investment in the fund because of the opportunity there. The fund has a 3-year investment term, but by the time the fund is halfway through, the investment opportunity is gone, and you'd rather redeploy the money elsewhere. But your money is tied up in that fund. Now, having said that, we will still bring to the board niche or satellite funds. We'll call the strategic relationships core, and the other ones will be niche or satellite. So the existing investments that we have right now, PIMCO Discos of the world, the other investments that you saw on the previous page, we would call those niche or satellite. They're specifically focused and targeted for one or more particular areas of the market, and we will continue bringing you those best ideas for approval, including funds that we have right now that are there for re-up, such as Avenue. So this, for us, we believe is a new and a more flexible and nimble way to make money in fixed income in an area where we do not expect returns to be very high. So in closing, the increase in the next steps, the increase in the space which will be coming from the asset allocation, the inclusion of these flexible or nimble mandates, we believe will help increase the returns in an area where the returns just aren't going to be very high. Now, we've been working and talking with Barry Dennis, SIS is right here, and he may have some comments as well on this, but our comments previously that we've had with him are very promising.
Yes, this was actually an idea that was hatched probably 18 months ago when we were talking about further deployment of the opportunistic bucket and the realization that it's very hard to be truly optimistic at the level we're working at. Pushing dollars out to managers that have the ability to be truly opportunistic is very important. I think initially with the program we have been successful, but two things. One, things were so dirt cheap, it was a fairly easy decision. They're not as cheap today. And number two, with PPIP, the government gave us a 4 to 6 month window to do proper due diligence. But we're not gonna have that time frame or that valuation discrepancy going forward. And it's important to get it out into the hands of people who can be truly tactical.
So over the next couple of months, we're going to be bringing to the board several of these core strategic flexible mandates for your consideration.
So I just want to ask Barry, so you were involved on the slide 8 on the recommendations. You do agree with the assessment that full spot and high yield will go down?
Yes.
And you're going to work that into the asset allocation project?
Those were actually baked into the allocations I showed you 2 months ago. 5% was the allocation of this portfolio.
But the source, I thought, was coming from equities and less from the other fixed income categories, right?
Yeah, so let's.
It's sort of part of the whole thing.
It's part of the
is
whole
way
thing.
it
It's
is.
hard to make a one-to-one.
Hard to make one.
So let me address that. So yes, the source will be equities, and that will help reduce the equity risk in the overall
Right,
portfolio.
very important.
Yes.
Barry, what is the universe of these managers that, you know, funds of our size can invest with? I mean, are there 10? Are there 200?
No. 10 would be the upper limit.
Okay, so it's a fairly small.
10 is the universe, or 10 would be the ones that we would invest?
10 would be the universe.
Universe.
Have
My
the
question is
capabilities.
universe. So if we're gonna pick 2 to 4, are we, it's obvious who we would pick from, is another way of asking.
I would say 5 are obvious and 5 you have to hunt for.
And it's also, what you wanna do is you wanna make it flexible and you wanna make it very broad. So if you look at the debt universe,
Right.
take the debt geography. You can start with corporate debt, you can go to real estate debt, you can go to US debt, you can go to European debt, you can go to Asian debt. And you'd like some guys to have the entire waterfront, if they're good at it, and some guys to we'll just have him be flexible for corporate debt in the US, maybe have a US real estate guy, maybe have someone, if they're the right guy, who can do corporate US and Europe. So you kind of have to look at the map, and then have a couple of guys specialized in parts of the geography, as I call it. And then those are like big partner mandates, and underneath that you pick some specialists. And you take a step back and you've built a very nice self-contained portfolio, and you've kind of checked a lot of boxes and moved down a lot of geography with a lot of discretion, filled in with the real experts. So for instance, later today, we have Avenue, right? Avenue is senior distressed debt. It's a re-up. That's just it. It's senior distressed debt, though. It's a real niche. But there's guys, you know, that will go further down the capital structure, further down distressed, et cetera, which we should have a deeper relationship with. Or take the PPIPs, for instance. The PPIP thing was terrific, and the PPIP story sort of ended. These guys still have our money for another 2 or 3 years, and the PPIP thing's over. But it's just a box. You'd like to have someone to say, all right, great the PPIP, or great you made those investments, now roll that money into something else. And we don't have any way, the way things are structured, to have the discretion to move into something else. That's what this is about. Give the right managers discretion to move the ball where the game's going, as opposed to, well, that was good for this year, but what about next year? It's really about flexibility.
And Martin, I think that there is something else that you're working on in terms of the next steps, which is the investment policy
Correct.
statement for this. So we should be seeing that.
We expect that we will bring the IPS to the board next month.
Okay. And are you also working on a tactical plan for us to approve that includes the investments that we will be considering?
Yes.
Great.
It's more of this map, right? I mean,
Yes.
as not just sort of understanding how we're diversifying this geography, capital structure, asset, subcategory of fixed income, all of that, right?
Yeah.
I would-
Right. Yeah.
So that when we get a recommendation, understand how it fits into the map.
Exactly.
The world has gotten more complicated.
Yeah.
But it, flip side, there's more opportunity.
And you need to have flexibility.
Yeah.
And again, as part of it also is, you know, we're not very nimble in how we do these RFPs. So rather than have an RFP for a piece of the map, just let the guy travel without the RFP.
Can I come back to Joe's last point? Risk for these things, I think, is not very clear. I understand that, but between fixed income and equities, that's somewhere between 6 and 20. I mean, it would be great to get a map of that as well, so that when we approve a manager, it's very clear to us that Avenue is actually less risk from a credit perspective than a lot of other people. So just to I think the sort of a template of some sort along opportunity set, risk, and not just return would be
When we
helpful.
talk about the specific investment in executive session, I'll give you some color on that.
Great.
Okay.
Okay. Any other questions on this? Good. Okay. Moving to corpus. Does everybody have a? No. No?
Do you have a middle file?
Share.
Okay. You guys need this? We good?
Yeah.
Okay. Corpus. Budgeting. So if you go to the first page, so in '04, the board approved corpus funding, which is basically the assets of the fund paid for the investment management team in the Bureau of Asset Management. If you look on page 3, this is the organizational chart when I arrived. I guess it was 15 months ago. So there were 37 corpus positions approved, of which this page has 26 investment staff, of which there were 18 seats that were filled. So basically working at half staff. Since that time, we determined the need for 17 new people. 7 have been filled and 10 are unfilled. So if you look on page 5, you can see the investment professionals that we've hired. We've got Seema, Barry, Catherine here. Amira, Addie, Neil, and Rafiq. And again, it's building out the buckets that we didn't have, as well as building out the hedge fund, beginning to build out the hedge fund platform. And everyone has a lot of experience, which is terrific. Page 6, you can see the open positions that we have. There's a couple of very experienced real estate people we hope to hire in next month. We've got 5 postings out. The most important one is the Director of Risk, and there's 3 open positions below that we've got in our pocket. But we'd like to first hire the Head of Risk before we hire the people that work for the Head of Risk. On the next page.
And financial risk here is really investment risk, right?
Yeah.
Can you expect that new Director of Risk Management to have a lot of say in these investment analysts once they're hired, once that person's hired?
I'm sorry?
In other words, the Director of Risk Management, once you hire them, do they have great say in these senior investment analysts?
Yeah.
Or,
I mean, they'll look over the
those
entire.
are risky assets right there.
Yes, they'll look over the entire portfolio as to risk, the different functions thereof. Then there's 10 additional people that we need to hire to partly build out the asset allocation, which are listed on page 8. So for instance, we approved hedge funds. We've got to build out the rest of the hedge fund team, so we hired Neil as an SIO, but we need another SIO and an analyst. Martin needs some people, a couple of people in fixed income, particularly as we get into this new opportunistic fixed income. It gets more complicated, more people required. In private equity, if we move into co-investing and some infrastructure things, we'll need some people. If you hire those 2 senior people, you need a junior person. And then ultimately, if we go through the asset allocation and decide to have an allocation to real assets and commodities, we're going to need a team for that. So that's 3 more people. So this page is another 10 people need to get hired. So if you look at the next page, page 9, you can sort of add this whole thing across. So again, this is by asset class on the left. There were 18 people when we started. We've hired 6. You add the other 10 that are open or pending. That gets us about up to the number of seats that we have in the existing corpus. Then there's the 5 more, so you end up with a team growing up to 44 investment professionals. 44 is still, in my mind, pretty lean for 117 billion, and again, the 117 billion doesn't have dollar amounts allocated for, say, the real assets or the PE or the hedge funds. So actually, on a totally outsourced model, the way we have it, because all the funds are managed by outsiders, this is closer to what other public pension funds have. Currently, we have about twice as many assets per investment professional. So we're really, again, understaffed relative to the size of the assets that we manage. So page 10 shows you what the organization looks like. Again, it's an organizational chart. So each of the heads of an asset class has enough people to manage these assets. So you can see Martin's team, Seema's team, Yvonne's team, Barry's team, a new team for real assets, and then the risk group over there. And again, we got 24 existing, we'll have 20 full empty positions. It's going to take us a while to hire these people, but we've got to get the postings out to kind of start this process.
Can I ask you, these are
Yeah.
people in the control's office that are just dedicated to the pension funds and the investment?
That's it.
They have no other duties
No.
with other city agencies?
No, these are your
Just-
investment managers.
These are our investment people?
100%. In addition to hiring them, you're going to need a couple of accountants behind it. Right? You get the hedge fund, you got a hedge fund accountant, for instance. And again, with the growth of the assets and the growth and complexity of the assets, we just need more people, right? There's 8 of those. And you can see on page 13, this is David Jetter's staff that, to your question, is 100% dedicated to these assets. There are other people inside the Bureau of Asset Management that are not 100% dedicated. They're not in this page. You don't pay for them. They're not part of corpus. So if you get to the last page, page 14, this is what it costs. So the first column are the people, the second column are the aggregate cost, the third column is the police share. So again, going across the page, when I started, there was a staff of 25, front and back of the house with the accountants. We've hired 6 people for $644,000. Total as of today is 31 people for $2.9 million. The posted hires that are open now is $650,000. That'll get us up to the 37 that were approved already for $3.5 million. The extra 24 people cost $2 million, and the total then is 61 people for $5.6 million. Or if you go across to the police section, the approved corpus portion is $730,000, and the $730,000 gets increased to $1,144,000. So it's a $400,000. So that's the plan. I think it'll take us at least a year to hire these people. So this increase in expense will get averaged out. You know, you only pay for what we have, so you don't get a bill for the increase until we actually hire the person, and then you get another portion of that year. So my guess is this whole expense won't roll in for at least a year plus. So we're going to all the boards. We're explaining all this plan. We'd like you to approve this, obviously, and then we'll set about trying to beef up the staff to get it to what we think is the right staffing level for these assets.
Let me ask you, with corpus funding, is that applicable throughout all of the 5 plans? There's only 3 that have corpus, right?
4 do.
4 do?
And the 5th that doesn't have, it's administrative corpus they don't have. So yes, it's
Administrative
applicable
corpus.
to all 5, Joe.
Everyone pays their share pro rata with the assets.
Yes.
And with the staff that you're looking to hire, just quickly go through that procedure. How do you identify, or what process you
Sure.
put out?
We have we start with a posting, right? The posting is then put on the controller's website. We send it out to a variety of organizations that we know, starting with, if there's a trade organization, we send it out for the asset class, we'll send to them. So there's a real estate trade organization, they'll get it. There's a private equity one. There's some sites that are for free, like Bloomberg Terminals. You can literally post all the job sites there, so whoever has a Bloomberg can see if they want this job. And we go the extra step. There are a bunch of minority groups that have groups that we send it out to. So we send it out to NAA, which is Latino, AIM, which is Asian Americans, CUP, NAIC, the Twigo Foundation, SEO, and there's probably 3 or 4 other ones. So our job is to make it as broad as possible. We get the resumes in, they go to the controller's human resources department, they sort of do a sifting, then it comes to the asset class head, who then interviews people, and we kind of keep going until we find people that we like. And it's out there, again, they tend to be out there for a long time. No stone gets unturned. In fact, there's usually an ad in P&I magazine as well. So we tried the magazine ad in the P&I, and then we try ads in whatever the asset class main rag is. Just
And then
to make
there's
sure.
your network, which is where you find the senior people.
And then there's our personal networks.
So that we're not using any like headhunting services or anything?
No, we do ask headhunters, but we tell them it's pro bono. We haven't gotten any heads. But yeah, we do and if you guys know of anybody, send them in.
Larry, can you go back to a comment, to make sure I heard you correctly earlier? Did you say something like we have twice as many assets per person than the normal pension fund?
Yeah. We have about $6 billion of assets per investment professional. And the comparable funds that, again, all externally managed, have about $3 billion. $3.2 billion per inside investment professional.
Can you give us an idea of roughly which of those funds?
I can give you a piece of paper.
Is that CalPERS?
Yeah.
This is something that, we have brought up a long time. That was, the impetus to this was that we just didn't have enough people, given the size of these funds, to be able to monitor and come up with strategies and work with it.
So we did our own unscientific survey. We called all the funds, right? And said, how are you guys set up?
How fortuitous that we have a sheet.
Because we had to figure, because the first thing when you arrive at an institution like this, everyone says, well, we have the right people. So when you look at it, well, this is clearly understaffed, so the answer is, well, what's the right level? So this is the top 25 public pension funds in the United States, ranked by asset class size. You can see the cities there at 111 billion. The yellow are the people like us that have no internally managed funds. So take CalPERS, since you mentioned CalPERS. CalPERS has 77 investment professionals, but they manage a lot of their money in-house. So that's just, it's a different business model, so we shouldn't be compared to that. The yellow guys, like Mass Prim, they do the same sort of thing we do. It's all outside managed money. So if you run your eye across New York City.
But none of them have 5 boards.
Well, that's right. Then you add complexity. Haven't gotten to the complexity.
What are you trying to say? More complicated? No.
Piece of cake. So we had 18, again, we started this, we had 18 professionals for $111 billion, so that's about $6.2 billion per investment professional. And if you just run your eyes down that column, for the yellow people, you end up with 3-ish on average. 3, 3, 3, 3, 4. So again, just quick rule of thumb, we have half as many people without doing real science. Half as many, and as Raji correctly points out, we're 5 times more complicated.
And maybe 2 or 3 times the work, may not be 5 times the work, but
it's more.
it's more.
Right, you should lean on more rather than less.
More, and it's more average out.
So this was just again, this was a simple benchmark that says yes, we're also at 6 billion for investment professional. We're the most on this page, right? So we're not close to the right number, in my mind, with 18. And then you get into simple things like complexity of asset class, how your assets are allocated. You know, if you want to, take private equity. There was 3 private equity people for $12 billion and 168 funds. It's just not built right. Right. So then you have to build from the bottom up and see where that gets you. And this is a little bit of a test as to, we're never going to get to the bottom of these numbers. We're not trying to get to the bottom of the number. We're trying to get to the right staff for the right, to make it feel like, people work hard, but we're servicing A, the clients, which are the pension funds, and B, making sure we see the managers. We talk to the consultants. We see the new investment ideas, and we make the whole thing work. So more is required. And again, as we get to a new asset class like hedge funds, we have 0 people for hedge funds. So you have SEMA, who's worked in hedge funds, which
Well,
needs
there's
a
nothing
team.
else to do, of course.
We had nothing else to do, right? You only had $70 billion of assets, but nothing else to do. And you say, here's a new asset class, you need a new team. So that, again, as we get more complicated, we're gonna have to get more people because there's no excess capacity in the system.
But also the hedge fund point is relevant because you needed the right person before you could start the implementation. So it's people before strategy, rather than saying, okay, now go out and start investing in commodities. You gotta first figure out what the strategy is.
Right, so we're gonna have this asset allocation. In there is real assets. We have no one that does real assets. So we can put that on a page and say, let's have some percent in real assets. Okay, go find someone to go help you with that, right? So the strategy, once you get the strategy, the execution is gonna lag a little bit. The good news about hedge funds is SEMA as a hedge fund person, you can kind of start that quickly, but then you instantly need reinforcements, right? Build the team out.
And now, are we competitive in terms of the salaries?
That's an
interesting question.
That's a difficult question.
We often ask the same thing.
Brings it to the choir.
I think that's been the basis of much of our argument for the last few years.
Touche.
So that is the elephant in the room, which
Yeah.
is that the structure of this is, despite the fact
Be
we're all paid at a
careful,
certain
be
level.
careful.
Exactly. But it has to be said, right? Which is.
If you want quality, you have to pay for it.
Yeah.
Right.
Yes.
And yes, we are in Manhattan, fantastic, we have the pool, except they're not interested if, and not only they're not interested, but they become transitory. We can't keep people, this is a 20-year exercise, this is not a 3-year exercise, right? So people come and go.
You have made our argument
Yeah,
in
I'm not surprised, thoughtful people will come to the same
20-year
conclusion.
period for police officers. Gotta pay for them, we don't want a transitory police force.
That's that extrapolation
Excellent.
problem he was talking about.
Excellent. Gotta remember that.
So I would say that, quite honestly, one of the things that Larry and I have talked about very openly is that I think we need to be bolder in terms of not just filling slots, but really forcing perhaps an issue that has lingered for a very long time about, are we getting the right talent? Not, are we getting enough talent? I think there's you made a very important point, Joe, which is adding these people is a way to do two things: reduce risk and identify future alpha opportunities. Couldn't agree more. But you need the right people in those seats with the right training and the right mindsets to lead us. It takes a lot to get a group like this confident in terms of doing things that we've never done before and doing them right.
And that goes to the larger issue that not only the beneficiaries better served by having a professional, knowledgeable staff monitoring and assisting the trustees in its investment policies and determinations, but the public, the general public, is better served also, because we're going to operate more efficiently, and they're going to get more bang for their buck with these funds.
Well, you can reduce pension costs if you're acting more efficiently.
So out the window.
Well, you can reduce pension costs if you have better returns.
Right.
No
So out
question
the
about
window
it.
goes the city's idea of doing more with less.
Actually, I think you can do
as
more
they-
with less as long as more doesn't include compensation. I mean, you know, it's in this very highly technically specialized case. That's all I can talk about.
Well, for the record, the unions at this table have been doing a hell of a lot more with a hell of a lot less, for a hell of a lot less compensation.
Well, I can't
But that's
go
our
there.
public plug, that's it.
I can't go there. I'm just speaking to the very specific investment skills that I know something about.
Oh,
but-
yes, of course. Very
Yeah.
narrow.
Now into executive session.
Can I also, again, you know best what you need to deliver to the boards what we need, Larry. But I as you've already heard me express very strongly, one of the things that BAM really lacks today is a senior asset allocation person. And 90 to 100% of the decisions we make, 90 to 80%, 100% of the returns of these funds and the variability of the returns of these funds, as Barry will tell you, are driven by asset allocation. So I realize that we're very grateful that we're doing an asset allocation exercise, but there's a whole theory, there's a whole bunch of research, which is voluminous and similar to what each of your heads have to follow for their own sectors, which we don't at all bring to the staff on a day-to-day basis and to the boards. Yes, we've outsourced this to our consultants, but we have consultants for everything else as well to help staff. So I feel very strongly that a void in this chart right now is someone with in-house with significant asset allocation expertise to guide us. Now, the other comment I'll make, which I haven't made yet, but Janice and I have been talking about, is for risk, I would really separate compliance risk from investment risk. And my worry is that you bring in a risk person, they get bogged down in the compliance issues, which you're gonna find two different people.
They're
One
totally
is a
different people.
lawyer and one is trained to look at, accounting, forensic accounting, and the other is an investment person trained on understanding quantitative models and why they work or don't work. So I just don't think that we can combine these things, and you tell me where they belong on an org chart, but it doesn't seem like compliance risk belongs in an investment org chart.
Well, you have to start with someone who understands risk and lays out for the city and the systems all of the different risks. And that there are, I didn't bring the list with me, there's 40 different risks that this portfolio has, at least, okay? I would tell you that we think about.
By the way, that's not unusual.
No.
For a
it just-
portfolio this
yeah,
large.
it's just, this any investment
This
portfolio
part.
has these
Endeavor.
risks, right? So, and you need someone whose job it is to think about that, all risks.
And monitoring it
And
on a
monitor
daily
it.
basis.
Then you break that job down into different risk components. Compliance is, I totally agree. Compliance is legal, it's make sure the IPSs are right, you have a system to check it all, it's everything, or all the partnership documents right, that's a compliance job.
Right.
And you could give it to legal, but then it's a legal job, and best practices is that function reports into risk, not into legal. Best practices.
Valerie just said, I don't have to work that much now.
The other risks, which I'll call financial and asset allocation, I'll put under risk, portfolio risk, financial risk, all the other risks, counterparty risk, default risks, are all different risks in that compliance. Different people all still go to a risk person who's thinking about how all the risks interrelate. Because if you get if you forget a risk, it can blow you up, and you say, well, how come we weren't thinking about that? And the answer is, well, we hived it off and someone else was thinking about it. So you need one person who only thinks about every risk and then determines the human as well as financial resources that get plugged into solving all the risks.
Let me just add one more thing, and just since you were talking about this. That type of monitoring of risk, also, wouldn't that be helpful in determining if we're getting the right return for
the risk.
Each of those allocations? So
Absolutely.
we should be getting, considering
Right,
all
we're
the
getting paid for it.
Right, are we getting paid
Right.
for each level of risk or each unit of return?
And there should be a risk report that the board gets once a month that goes through charts. Here are the risks, simple questions. You can say, hey, we're thinking, you're worried about what's our Greek exposure? You should be able to say, here it is, it's right here, it's on this piece of paper, here it is. What happens if rates go up? Well, we've got that sensitivity, we've run it, here's what happens. Here are the pieces that move. Here's the analysis. To do that, the risk person, because we're gonna have to, at some point, I'm sure, come back to you guys and say, all right, now we have the risk person, here's what he needs. Here's the list of software, computer programs, and it's expensive. But again, it's expensive on a dollar basis, it's hundreds of thousands of dollars. It's de minimis relative to $24 billion pension fund.
Or the 400 million in fees we pay.
Right, I mean, again, you can get, it's expensive as a procurement. It's
But really, that's
it's a
more
penny.
upfront cost, because that once you buy the software, once
Yep.
you buy it, then it's just a matter of updating, and it gets,
Well, you might want
over
to,
time.
there's some of that, you might license it, you might say, look, we want to have a relationship with this firm. There's some firms we've talked to, and they say, well, gee, you have the best software, what does it cost? I said, well, $2 million a year. So, well, you can't have $2 million a year software. So you've got to have the risk guy, to your point, help us figure out what it is we need, then come back to you all and say, look, this is what we need, here's the risk guy, here's the plan, because he's gonna come with a plan, he or she, gonna come with a plan, and I would tell you part of the plan is asset allocation, because he's the person, he or she is the person who monitors it, will have opinions on it, and then it comes back up to the CIO, to the board.
So in terms of priority, which are the top 3 positions you?
The head of risk is the number one priority.
Risk.
We've had an open procurement for 6 months. To your point, we're not paying them enough. Plain and simple.
That's why they're not.
Right. We're not
running
clear,
through these
we don't
forms.
have a market clearing price, which
Larry?
I've been talking about internally, but we're gonna have to figure out what to do about it. If we find a position that we absolutely positively need, and we're just not offering enough money, what do we do about that?
Should we start taking a collection now?
Maybe. I've talked to Dr. Jeter about how we do it.
Larry, just a quick question. Is there any analysis or as far as correlation to overall performance of the fund and the staffing that the fund has?
I'm working on that.
Oh, you are? Okay.
Yeah.
Be interesting to see.
It's staffing and compensation. Because you can have a big staff, but maybe it's the wrong staff,
Yeah, that's correct.
right?
You're right.
So I'm working on a comparison, which is complicated, as to there are different models as to how you do the whole thing, right? Not all of these people, clearly, look, I mean, the yellow guys have it all outsourced.
Yeah, I was gonna
The
say,
white guys have
you gotta
some
compare
in-house,
apples to
some
apples.
out-house, and you might take a step back and say, what's the best way to run the whole thing? Right, just because we run it like this now doesn't mean it's the best way to do it, and if you're gonna hire the people, how do you want the people to relate to everything?
Right.
So, we're looking at all that. That's a much more complicated analysis, but we're working on that.
But the good news is that there are models out there that we can look at now, right? And
Yes.
that have been successful for a while, so
Yes.
You just don't need the
But we
right
wanna
player
be
in the right
involved.
position.
They're
That's
different.
the idea.
Yes, we do.
We wanna be the model.
Agreed.
Absolutely.
So
So I need
I
a
think you're
s-
hearing again from us, Larry, support for version 2.0,
Yeah.
which pushes perhaps, and maybe we'll win this, maybe we won't. But as a board, I think what you're hearing is just more support for you to go out and do what you need to do to come back with a plan that goes beyond this, perhaps in terms of the quality, caliber, and therefore the comp people.
Okay, this plan is based on current comp levels. So I guess I need a vote. Do I need a vote? Do I need a vote?
You need to vote on
I
that
need a vote.
increase, right?
We're gonna need a vote on to increase the corpus, but
Decrease the corpus from,
just so that you wanna make the
Increase of
Thad,
413.
help me here.
Sure, so if you turn to page
14.
14.
So you wanna raise it from 3.5 to 5.6?
yeah, yeah.
And that's to be done over.
Well, what I would say, Joe, though,
Yeah.
when you're looking at it, I would kind of focus on page 14 as you suggested, and the planned additions. Your police share of that is the $413,000.
$413.
So I would isolate that in terms of this motion, if that works for the board.
So right now, our current share would be approximately
600,000.
700,000,
Right.
right?
Yeah.
Yeah.
And you're gonna go up 400,000, that would bump us up to 1.1 in terms of our share.
Correct.
Right.
So you,
So
so
we're
we're
looking-
just agreeing to it right now, an increase of 413,000 on our share.
For the 24 heads.
Yeah, tie it to the heads, because if we come back, I don't think we wanna have to water torture if we have a body and it costs $25,000 more, and now we're at a budget. Unless you guys wanna go through that water torture.
No.
24.
So I would take the bottom line, Thad.
Okay, so the
I'd say
top,
you want to approve 61 positions for $1,143,000, subject to.
So the
right?
resolution's gonna be, for this fund, to increase the, corpus funding from its current state to an increase of 413,000,
for a total of 61 heads,
for a total of 61, to staff 61 positions.
Yeah.
at a cost of 1 point.
Approximately, because you don't forget, these numbers, this math is based on the asset split today. So they're 24 out of 118. If the numbers move, their piece is gonna move. Right, so it'd be a little ginger on, I'd put it approximately. I'd say 61 positions for approximately a million.
1.1 million.
Yeah, 1.2 million. That's
So
not
that would be
right.
the resolution, that we're going to, move forward to hire approximately 61 positions, with a total approximate cost of 1.2 million.
Yeah,
Yes.
That would be our resolution.
exactly.
You have that, Annette?
Yes,
As a
I do.
resolution?
Resolution or motion?
Okay, that would be the motion. And, what,
Do you have a second for that?
Second.
okay?
All in favor?
Aye.
All right,
Thank you.
thank you very much. That concludes the public agenda. So we have a motion